morning, everyone. Welcome to the second lecture of Advanced Performance Management paper of ACCA. I hope you all are doing well. We'll continue our discussion on the first chapter, which is the Strategic Management Accounting. If you have any doubts from the previous class or any other general doubt with regards to the paper, then also you're free to ask me right away. If anyone has joined us newly today, let me be clear, you are free to put up your doubts and concerns in the chat box. I will address them right away in the class. Okay. Let's start. So we had completed activity 1, right? Till here, just let me present. Can we get the slides prior? Shaldia, I prefer to send the slides after the class. The reason being, sometimes during the class, I keep on inputting something to the slides and to the Excel files also. You know, just as per the convenience of the class, if something else is needed, like we prepared that time management slide yesterday. Now. So I prefer to send the notes after the class so that it's like comprehensive everything, including mine inputs, and during the class, if anything else is needed, I input it then and then send it across. So you will get it in this week, maybe by tomorrow morning or tomorrow or Tuesday, you will get the notes. So you can study them. Okay, Shalya? Yes. So we had completed till this activity yesterday of Hydra company, and we discussed the different levels of information with new recommendations for the performance measures which can be undertaken by this company. Let's continue. The new topic is strategic models and performance management. So you will be studying a lot of models. Which one model did I tell you to include in your summary notes yesterday? Did you start preparing that summary note? Any Excel or Word file? I would recommend Excel. You can create different tabs for different models. Okay, like for Robert Anthony, you can create one tab, Robert Anthony, and then second tab, like this one I'm going to tell you, SWOT analysis. Okay, so prepare one Excel file, add one tab for Robert Anthony, like I said, and this is the second model which I would suggest that you include it, and that is SWOT analysis. SWOT analysis is something you all would have done maybe sometime in your life with respect to your personal bits also, like what is my strength, what is my weakness. So all of us are aware, and in fact, maybe even when you're going through an interview, the interviewer normally asks you, what do you consider your strengths are, right? So this is an analysis which is done also for companies, that what are the strengths, weaknesses, opportunities, and threats for a company, right? So strategic models we are going to cover here, and the first one of them is SWOT analysis. So SWOT analysis is nothing but a critical assessment of the strengths and weaknesses, opportunities and threats affecting an entity in order to establish its strategic position prior to developing a strategic plan. To know where I am today. So today, if I'm doing my SWOT analysis, it will help me to understand what my position is, and then accordingly, I can develop a strategic plan of action for future. That what do I need to do in the future? So let's say today my strength is communication. So what I'm doing to enhance my career on the basis of communication. So that is what I will start developing, a plan to enhance my strengths and to work upon my weaknesses until they become a strength themselves. So this type of SWOT analysis is done also for companies, right? So I have a short video here, which I shortlisted for you. Let me present that. Give me a moment. So what I do now, sometimes I include videos for models, interactive videos. They help you to understand things. Let me present this.
Fruitsy দিয়ে ফিক্স করা দাঁতের গ্যাপ ততটাই সহজ যেমন ঘরে বসে অর্ডার করা ফ্রম আ ফুড অ্যাপ। Fruitsy ইনভিজিবল টিথ অ্যালাইনার্স দাঁতের গ্যাপকে ফিক্স করে। বুক করা ইজি, ব্যবহার করা ইজি এবং পকেটের জন্য ইজি। এবার স্মাইল ফিক্স করা হলো ইজি পিজি টুসি। মেকো অ্যাপ ডাউনলোড করে স্ক্যান বুক করুন।
Okay, great.
Let me know if you can't hear or see. I am just going to start playing the video, okay?
So in this lesson, our goal would be to apply the SWOT framework in practice. Shouldn't be that difficult, right? The company we'll examine is Starbucks, the well-known U.S. coffee company and coffeehouse chain. It was founded in Seattle in 1971 and operates in several countries around the world. Let's start with the company's strengths. First, almost everyone knows its brand, right? So it definitely has a strong brand recognition. Starbucks has been proclaimed the most recognized coffee brand in the world, quite an advantage regarding other companies in the industry. The firm's brand is one offering of a differentiated product to customers, which is coherent with its strategy and pricing. Clients have expressed they love the atmosphere in Starbucks coffee houses. They can use free Wi-Fi and enjoy the coffee drinking experience to the fullest. The company owns thousands of outlets around the world, and its clients can find it even when traveling overseas. That's a strong advantage, as it ensures loyal clients can remain such even overseas. And finally, Starbucks supply chain management ensures the quality of coffee served to customers is excellent. The company chooses its suppliers carefully, which improves the quality of its products and ensures clients receive a super coffee experience. This is another choice in sync with its differentiation strategy. Okay, very good. Let's take off our rosy glasses.
So I would like to clarify something before we go ahead in the video. Strengths and weaknesses are something which are internal to an entity, which is within the framework of the entity's environment. Whereas opportunities and threats, they are external to the entity, something which affects the entity from the outside, not from within the environment, okay? So strengths, if you look for Starbucks, this entire video is for taking Starbucks as an example and finding out its SWOT, right? Strength, weakness, opportunities, and threats. So you will see that they have given out the strengths like brand recognition. Clients are what? Your customers who come to Starbucks, they love the atmosphere of Starbucks. So that is what internal, right? Customers are internal to the company. Similarly, now they're going to list the weaknesses. So you will realize that strength and weaknesses, that is S and W, they are internal to the company, whereas opportunities and threats, they are external to the company. Do follow the example properly. It will give you a lot of insight and a real world example, right? So it's going to be helpful. Have a look.
And consider some of the firm's weaknesses. One could argue Starbucks offers the same product in all countries where it operates. It does not customize it according to the different tastes of people in different geographies. For some customers, this is an issue, and they prefer competitor products tailored to their specific geographical preferences. In addition, Starbucks has a premium price policy, which is not in line with most customers' expectations. Not all countries have enough middle and high-income class individuals who can afford to pay extra for their coffee. Weakness number 3 would be the high employee turnover that the chain's coffee shops have. It is difficult to serve coffee as a premium product when the company's baristas have been on the job for only a couple of weeks. In terms of opportunities, we can say the following. Starbucks can access new countries easily. It simply has to apply its existing business model in these new geographies. Emerging markets can be a great source of growth for the company. Starbucks has also entered agreements within the entertainment industry and partnered with movie-producing companies. That can be a great opportunity for the firm, too. One of the biggest threats for Starbucks is the saturation of the American market, which is where most of its outlets are located. Consumers are increasingly invested in healthier lifestyle, and some substitute products are better positioned to capture the attention of the health-conscious clientele. Okay, we'll stop here. This is what a SWOT analysis looks like.
So you saw the SWOT analysis of Starbucks. What did you realize? So one of the threads, it said that there are better, healthier alternatives available for Starbucks coffee. Can you give me some examples? What could be healthier alternatives to coffee? You could say green tea. So people, they are now becoming very health conscious. So they want to keep themselves, healthy, and they actually want to live by that principle. So they would not want to go for coffee. which has got caffeine, and sometimes people take sugar along with coffee. So that's not considered to be healthy. So this was an example of Starbucks. You will find n number of videos on YouTube whereby you can see, SWOT analysis of multiple types of companies. So you can find out more. This was one of the examples, okay? So I hope you realize that when they were talking about strengths and weaknesses, they were talking about factors which were internal, like what? Customers, the product itself, whether or not it is customizable, whether it is expensive. So these were all what? Internal, that this is within the control of the company, okay? Opportunities and threats are external, like whether they can set up new shops, coffee shops outside of any particular country, so they have to look about the regulations which are prevailing in that country, right? Then what? There is a saturation in the US market, so there might be more new alternatives coming up, new brands which are coming up in the market, so there has to be some saturation. Is it within the control of Starbucks that a new company, new coffee shop company is coming or not? No. So these are factors outside and not within the control of the company. Whereas strengths and weaknesses are internal and they can be easily managed by the company. Okay. So that's what's given here. Strengths and weaknesses involves consideration of internal factors, and opportunities and threats involve consideration of external factors. Now let's see the relevance of SWOT analysis in performance management. So that one slide was introduction on SWOT analysis. Now let's see how SWOT analysis can help in performance management process. Okay. So how can it help to improve the performance and ensure goals and objectives are met? As we discussed yesterday, what is performance management? Planning, controlling, and then taking what? Corrective action to ensure that you are achieving the goals and objectives. So how can SWOT analysis help you to do that? First one is identifying weaknesses and threats. See, each one of us, we have some of our weaknesses. If we know what they are and if we can take actions to correct them, nothing better than that, right? So if you are conducting SWOT analysis, you can find out the issues within the entity which can be addressed, either within the organization or the external environment. So there are some threats. So weaknesses, as we discussed, that it is within the control of the company. So you can do something to correct it. But ma'am, what about threats? How do I, address the threats? It's not impossible to address the threats. You can do something which can prevent the threat from materializing. Okay. So like in this example, which we discussed, what were the threats that were given? Healthier lifestyle threats, right? It's not within the control of Starbucks that people are now adopting healthier lifestyle trends. But what Starbucks can do is to develop multiple varieties of products, right? Like healthy coffee. Absolutely right, Shalya and Ayushi. So company can start offering healthy options. So this is what it is possible only if you're doing SWOT analysis. Unless and until you know that what are the threats surrounding your business, what are the weaknesses inside your business, you will not know what to do. So once you have identified these weaknesses and threats, you can start taking corrective action. Okay. Then next point is identifying strengths and opportunities. You know what your strengths are. You know what there are opportunities coming your way. If you know that, first of all, strengths, you will try to improve your strengths or even maintain the strengths, that this is something good about me. I need to ensure that I keep on going along with it. Or there is an opportunity ahead of me. I will take action to take benefit out of this opportunity. See, there could be an opportunity, but if you're not utilizing it, then it's of no use. It's just something sitting outside, an ice cream which you're not eating, just there on display. So it will one day it will melt away, right? So similarly, if there is an opportunity, you have to take action to make use of it. So that is possible only if you're doing SWOT analysis. Then third is maintaining strength. So both these points are interrelated. First, you identify the strengths using SWOT analysis, and then you work on maintaining these strengths, right? Having identified its strength, an organization must ensure it continues to perform well in the organization. Okay, then identifying critical success factors. So what does it mean? What are the key areas in which an organization needs to perform well in order to achieve its goals? I'm not sure if you've heard them. It was a part of PM paper. Key critical success factors and key performance indicators. Okay, CSFs and KPIs, they go hand in hand. So what are critical success factors? As the name suggests, the factors which are critical in ensuring the success of the organization. So if you want to see it at the personal level, what is my critical success factor? You can think that, I will be thinking, what can I do? What is something so critical that if I do not do, I will be at a loss. Okay. So similar to that, companies also, they find out the critical success factors using SWOT analysis. That these are the key areas I cannot do without. Now let's take an example here. Let's take any e-com company, if you're talking about, let's say Amazon, Flipkart. What do you think? Just give me examples, okay? What would be the critical success factor of an e-com company? Something, if they do not do, they'll not be able to sustain themselves in the market. Absolutely right, Shalya. Timely delivery. Because customer satisfaction is dependent on timely delivery. So imagine Amazon commits a date of 11th of January for delivery to you, and then it delivers the product 1 month later. So you as a customer will feel that what's the use of giving me a date if they're not going to follow it, right? So timely delivery is one critical success factor. And there can be a lot of critical success factors for a company. Timely delivery is definitely one of them for an e-commerce company. Then second, Shradha says product quality and customer service. Absolutely right. So you feel so comfortable making online purchases today, online shopping today, that you know that if you face any problem, you can call up the customer care number and they will try to address your concerns, right? So that is possible only if you are identifying the critical success factor. Now imagine the company does not lay focus on its critical success factors, okay? They will not know what is helping them to attract and retain the customers. Okay, so that is the importance of CSF. Amit says maintaining quality of products. Absolutely right. If you offer cheap quality products on the website, customer will order once, maybe twice, but then he won't come back. Okay, so that's CSF for an e-com company. Next, Ayushi says easy return policy. Yes, if you are facing hassles, like imagine now if the e-com company, like let's say Flipkart or Amazon, they start asking you to send the products by courier. Their delivery agent will not come to pick up your product. Rather, you have to courier it back to them. Will it be a good return policy? No. You will feel that, oh my God, every time I order and I don't like my product, I will have to go to the courier service and then make the return of the product. So that shows that it's not a good return policy. Okay. Then yes, easy refund. Absolutely right. Now, you all would have seen that, you order something, you make the payment also, online bank payment if you have made. If before the product is even delivered to you, you change your mind. You find it a cheaper alternative somewhere else. You cancel it immediately and then you get the refund back to your bank, right? So that is the convenience. You don't have to even worry. So there was a time, like 5-6 years back, I used to check whether the company has refunded my amount to my bank or not. But now today I know that these companies, they work so, perfectly. I don't even check that if I have placed a return or a refund request, have I got my money back or not? I trust them that yes, money would definitely have been received. If I just get the message that yes, your product has been picked up, I will definitely get the money back into my bank account. So these are the critical success factors the companies have identified, and now they are working to ensure that they retain these they work on these factors and they retain that efficiency forever so that the customers remain loyal to them. Okay. So that is CSF. I hope the entire discussion helps you to know what a CSF really is. There is a proper topic on this subject as well, like CSF, KPIs. With this brief introduction, I believe you can set the tone right for what CSF is. Then next is determining information needs. Is the organization measuring performance in the areas which SWOT has identified as being important? This is nothing but talking about KPI, that is key performance indicators. So you have found out that these are my CSFs: timely delivery, then if easy return policy, and everything. A lot of key success, critical success factors you identified. You have identified them. Then what? Are you not going to measure them? Yes, so you are going to measure them by defining the measures, right? If you have, what is it that I'm going to measure? So timely delivery. Give me a metric which I can use to know whether or not I am making timely delivery. Give me a metric. How can I know that if I'm making timely delivery or not? That is known as a KPI. Try and give examples. How can I know? Yes, Ayushi says customer feedback. Then Shalda says time taken between order placement and order delivered. I'll give you one more example. Then I can check the difference between the estimated date which I gave to the customer versus the actual date to know whether or not I delayed in the delivery. Okay, so these are some KPIs which I can use. Then Amit says comparison of number of orders with competitors. Number of orders, no, but we can compare the time that what is the time the competitor is taking versus what is the time I am taking. Since we're talking about timely delivery, na, that's why I'm with. So this is a KPI for measuring the critical success factor of timely delivery. Okay, so this is determining the information needs, and the second layer in the SWOT analysis. First, you do the SWOT analysis. Next, you identify the critical success factors. And then third, you set up the information needs or set up the KPIs. Okay. Then next is evaluate targets. Are targets realistic and achievable in the context for the opportunities available and given the threats an organization faces? So obviously, if you are working, you will know this. That there are targets to be achieved in a company, right? That this is the sales target I will strive to achieve in this year. This is the profit targets. This is the number of sales orders I have to receive in a particular month, so on and so forth. That there are targets. Imagine a company sets unrealistic targets for its employees without considering the threats, the weaknesses it is surrounded with. Will those targets be realistic? It won't be. Same for strengths and opportunities also. So if you are not considering your weaknesses and threats, you will be overestimating your targets. You're not considering the negative impact which could be caused by weaknesses and threats. Yes, Shalvia. So such a target will be demotivational. The employees will feel that the top management doesn't know anything. They don't know that these are the problems which we can face during the year. They're just saying achieve this much sales. So this will lead to demotivation among the employees. Then similarly, if you're not considering the strengths, the opportunities, then what will happen? You will be underestimating your targets, and this will lead to inefficiency. You could have achieved more, but because you did not find out your strengths and opportunities, you set up lower targets for yourself. This leads to inefficiency. So setting up extra target can lead to demotivation. Setting up lower targets can lead to inefficiency in the organization. So a good SWOT analysis is really important to ensure that you're setting up realistic targets for the people of your company. Okay. So that was SWOT analysis in performance management. Is it fine? Any doubts here? What is SWOT analysis? It's clear. Strengths and weaknesses, internal. Opportunities and threats, external. Weaknesses and threats, they impose the negative things which might happen to you or which are already happening. Strengths and opportunities are the good points, the positive impacts on your business. And then we saw that how is SWOT analysis useful in performance management, right? You identify your weaknesses, you identify your threats, strengths and opportunities, and then you try to maintain those strengths. You take corrective action for threats and weaknesses. Then you identify the critical success factors and the relevant KPIs. Then you set up good and achievable targets, which is motivating for the employees. So this is the importance of SWOT analysis in performance management. So make just a small tab in your summary note for SWOT. Write down strengths, weaknesses, opportunities, and threats. Strengths and opportunities are positive impacts, and they are strength is internal, opportunities external. So likewise, you can make a small table in that tab. Is that okay? Just when I'm telling you now, what you do is just keep one Excel sheet open, add one tab, SWOT, name that tab SWOT, and later after the class is over, you can just complete that table. Okay. Do follow this approach. It's really important for the PM and APM papers. Okay. Then next is BCG metrics. You might have heard about this name a lot from me yesterday. This is the second model in the strategic models which we are going to study. First, a small video here as well.
The Boston Consulting Group matrix
Do let me know if you can't hear or see. I'm just going to start presenting right away.
The Boston Consulting Group matrix is often used to determine where a business currently sits in relation to other businesses in regards to its market share and that market's growth. Where your businesses fall on this graph will make them a dog, cash cow, star, or question mark. Putting your different businesses into these categories gives a holistic picture and helps guide where best to invest. But how do we construct a BCG matrix? Well, let's take a look at how to plot it. The two axes are market share, which is the percentage of the market that the product serves, and market growth, which is how fast that market is currently growing. But what do the different quadrants mean? The dog quadrant means your business has a small share of a market, which has a small growth and follows the idiom, worked like a dog. It's difficult to argue for investing in something with minimal growth, and as a result, these businesses are often liquidated. Cash cows, on the other hand, are a much safer place for your business to be in. Having a large market share with small market growth usually means large returns for little investment, which means you can milk it for all it's worth. Stars are bright and shiny and on their way up. They can attract investment and help a business to gain or maintain a dominant position in a space of large market growth. Which leaves us with question marks. These products don't have significant market, which means with analysis and the right investment, question marks could become cash cows or even stars. While the BCG matrix's nomenclature isn't exactly orthodox, the graph helps visualize various companies' performances and offers a sound starting point for analysis.
that was a really interesting video, good animation on BCG metrics. Just to give you a brief introduction, what really it is going to talk about. We have a detailed slide on this. So what were the 4 quadrants of the BCG metrics? What were the 4 quadrants of the BCG metrics, which you just saw in the video? Question mark, yes, star, cash cow, and dog. Absolutely right. Very good. So these were the 4 quadrants. So what a company does now, it identifies which of its products fall where, and then take the action accordingly. That if it is a cash cow, what does it mean? That it has a high market share but a low growth. So whatever goodness it can give me, I'll try to milk it, as the video said. Okay. So accordingly, if you have done that identification, which product belongs to which quadrant, you can take necessary action accordingly. Okay. So let's have a look at the detailed slide, and then we can discuss further. So the BCG metrics, it was, why is it called BCG metrics? Because it was developed by Boston Consulting Group in 1970. It examines, you don't have to remember it, okay? Just remember it as BCG metrics. It examines the interrelationships between the range of products or services offered. So it is talking about what? Your products and services. Remember that within a company, you're not classifying companies in the BCG metrics. You are classifying their products or services in the BCG metrics. Remember that. Students, they remain confused that they classify companies in BCG metrics. No, you're classifying a company's products in the BCG metrics so that the company can decide what action to take on the basis of that classification. Okay, so BCG metrics examines the interrelationships between the range of products or services in the market and the market's attractiveness as measured by its capacity for growth. Okay, that what is, so first of all, you're going to check what is the market share. So the 2 key important levers which we have discussed in the video also, that is what? Market share and market growth. So you're going to check for each of the product, what is it? Is it high? Is it low? Okay. So analysis can be done at 2 levels. First, as I told you, product or service level. The brands or product services offered by the firm are examined to determine their current position and prospects. Another way, the strategic business units. So please understand. Let's talk about ITC. Okay, ITC is offering multiple products, and let's say I'm talking about the FMCG sector. It is offering shampoos, it is offering soaps, it is offering detergents, a lot of range, and then biscuits, whatnot, noodles, so many things like Yippee we have from ITC. So what it can do when it is preparing its BCG metrics, it will classify these products in the 4 quadrants. So that will be product or service level BCG metrics. Another way is the corporate level. Now, when I say corporate level for ITC, we discussed yesterday. So ITC has got 3 sectors: FMCG, tobacco, and hotel. So it can prepare its BCG metrics at corporate level also. Like it can classify FMCG as a whole, FMCG as a whole sector in a, let's say, one of the quadrants as a dog or question mark, whatever it is. So corporate level BCG metrics means within that company, there might be strategic business units. Proper classification has been done within the company. The strategic business units of the diversified firm. So the firm is diversified. It is into 3 businesses. They are examined for their interrelationships and balance. So where is ITC's FMCG business market share? What is its growth? So that will be corporate level BCG metrics. Product level BCG metrics will be what? ITC's Yippee noodles market share and market growth. So when it will be calculating its market share, it will be comparing it like its market share is, let's say, 20%. Maggie noodles from Nestle, that how much share is that having? So that is the type of two types of BCG metrics which can be done. One is product level, another is corporate level. But are we classifying companies as a whole in BCG metrics? That ITC is a dog, HUL is a question mark? No. Within the company, we are classifying the interrelationships, between different products or maybe the different strategic business units. Is this part clear? Are you able to differentiate when I'm saying classifying a company as a whole or classifying its products or its strategic business units? Remember this classification, this point out. Students, they tend to remain confused about this. Okay. So the BCG metrics classifies products and or services in terms of potential cash generation and cash expenditure requirements. The matrix presupposes that there are only two factors that directly influence competitive position. And what are they? As we saw in the video, growth rate and market share. So the growth rate of the market segment of the organization serves. What is the year-on-year growth in sales of each product? That is what? Growth. And market share is what? So if it is 100, total pie of FMCG business is 100, and then ITC is occupying 45%. That is its market share. The relative market share of the segment held by the organization. That is the organization's market share compared to the largest competitor. So let me tell you one thing. Here, I will present my Excel. What is the difference between relative market share and absolute market share? So there are two terms. Absolute market share and relative market share. Pay attention here, okay? So let us say FMCG sector is 100 and I put these numbers above this. FMCG sector overall is 100. I'm talking about noodles, okay? So Maggi is having a share of 52%. And let's just say that there are only 2 or maybe we can take 3 also. Then Yippee is, let us say, 43%. And then others. Okay, I'm not putting any name here, others. Others is what? 5. Okay, so this is the overall share of FMCG sector. So if I make a pie diagram, out of it, 52% will be with Maggi, Yippee 43, and the others is 5. Now let us say I am finding out the absolute market share of Yippee. What will I say? It will be what? 43 as a percentage of 100. 43%. Okay, I'm not comparing it. Relative means what? You're relating it to something else. So the absolute market share will be 43%. When I say relative market share, what was the definition? As compared to the largest competitor. Okay. Now tell me, Yippee as a percentage of the largest competitor's market share. This will be my, I'll not put it into percentage. 0.83. Here also let me put it as number only, as a decimal. 9.43. Absolutely right, Aishi. That's what I did. 43 divided by 52. Like as compared to the competitor, what is my relative market share? Okay, now when you have understood this part, read this again. The slide. Is it using the absolute market share or the relative market share? It is using the relative market share. The relative market share of the segment held by the organization, that is the organization's market share compared to the market share of its largest competitor. A relative market share of greater than 1 indicates that the product or business unit is the market leader. Is Yippee the market leader? No, Maggi was the market leader. So you can see here, come back to the Excel. See, that is why its relative market share is less than 1. right? That is GP is not the market leader. Whereas if I were doing this calculation for Maggie, then the market share would have been, relative market share would have been greater than 1 because its largest competitor would be Yippee. Yes, Shalya. So for Maggie, the relative market share will be 52 by 43. Why? Because for Maggie, the largest competitor is Yippee. Okay. So if I were doing for, this is for Yippee. Okay. And if I find out the same thing for Maggie, what would I do? Absolute market share would be 52 by 100 and relative market share would be 52 by 43, which is greater than 1. That is, Maggie is the market leader. Is it clear, the example? Okay, great. Then let's come back to the slide. See. Now the same quadrants which we talked about, right? Cash cows, dogs, question marks, and stars. A really important model. Make this the 3rd tab in your summary notes. I hope everyone has started preparing the summary notes. This is the 3rd model we are adding to the summary note. Okay. What is this? The BCG metrics. You will be copying. Okay. So you can copy this diagram. So you will get the slides right after the class. So you can copy the small diagram and then in your words, write what stars are, what question marks are, everything. So don't copy this explanation, but copy this diagram. Okay, so you can keep it in your Excel file. Okay, now let's talk about each one of these quadrants in details. As we saw in the video, there are 2 levers. What are they? Relative market share and market growth. So high market share and high market growth, it denotes a star. This is my star product. You would have heard in company statements that this is our star product. Okay, so if we are talking about FMCG, ITC at the corporate level, when I say corporate level, what will be the strategic business units I will be talking about? FMCG, tobacco, and hotel. Can you guess what would be the star for ITC? What would be the star for ITC? High market share and high market growth. Let me search if there's a video on this. You give me the answers. I'm just looking up a video. I'm getting multiple answers. According to me, what I feel, see, just a second. We're talking about a high market share, okay, and high growth. So this, I think it will be a case of FMCG. And that is the reason the company is, focusing a lot on this sector. ITC, if you read its, statements, the annual statements, you will realize that the company is changing its focus from tobacco. So ITC, if you know now, the name of the company is Imperial Tobacco Company. It started off as a tobacco company, but then now it is changing its focus from tobacco to FMCG. Why? Because they are having a good market share. They want to increase it further so that they will become the market leader. Okay. Yes, Shalvya. The reason behind it is image first, and also the health conscious attitude of the customers. Now people, they're becoming conscious that cigarette smoking is not good for health and everything, and the n number of government regulations around it, right? So it's a highly regulated industry, tobacco. So it has a high market share, and it is reaching that level. FMCG is reaching that level of high market growth also. Okay, so that is why it is a star. But if I were talking about cash cow, I would say tobacco is the cash cow. It is a complete cash flow business, tobacco. Okay, it is a market leader, ITC cigarettes, and it is low market growth. Why? Because of health conscious attitude of customers and everything. So that is why it is a cash cow. So are you able to understand? Star would be your FMCG business, because it has a high, it may not be the market leader. See, high does not mean having a greater than 1 relative market share. It means comparatively high. It has not been defined, so I will also not say greater than 0.5, then it is a high market share. It has not been defined in the BCG metrics. So it is a high market share. It has high market growth. FMCG as a whole is growing. Okay, so that is why FMCG is a star for ITC. Tobacco would be a cash cow. It has a very high market share. I'm not very sure, but it could be the market leader in cigarettes in India, but it has a low market growth. Why? Because of customers' health conscious attitude, right? So then hotel business, hotel also, I think it will be something around cash cow only. It has a high market share. ITC's hotels, they are very prominent across the country, but it has a low market growth. Hotel industry is going through a low market growth. Yes, Shaldi, I think I just answered your question. Can the hotel chains also be a cash cow? Yes, since the growth is not yet high, yet ITC would significant share. You have, I said the same thing just before reading your question. Yes, hotels are also cash cows for ITC. Okay, Shaldi? Okay, so I was just looking up a video. I am not sure, I haven't watched this, but it seems good. Let me play it for a second and then show it to you. I want to cover an example on ITC, BCG metrics.
It's as easy as घर बैठे ordering from a food app. Tutsi invisible teeth aligner fix दांतों का gap. Easy to pop, easy to use, and easy on the pocket. अब smile fix करना है easy peasy. Tutsi, download the Mako app and book your can now.
Hello everyone. Today we are going to learn about the BCG.
Not getting good examples, but I think the example we discussed in the class is good for ITC. I got something for Samsung. Let me check.
Hello everyone. We are going to learn about the planning tool designed by Boston Consult.
Okay, let it be. So our example was a good one. Okay, so I'll just close this. Yeah. Okay, so stars are products or services with a high relative market share in a high growth market. In the short term, they require expenditure in excess of cash generated. So if you're talking about FMCG, I told you, right, they're changing their focus from tobacco to FMCG. Don't you think currently it would be spending a lot on marketing, on product development, new products, so market research? This is the type of expenditure they would be incurring to ensure that they become really big in the market. Okay, so in the short term, they require expenditure in excess of cash generated, okay, to maintain a relative market position. However, they promise high returns in the future. Obviously, that is the reason they are changing their focus now, that they expect high returns from FMCG in the future rather than from tobacco. I hope this is clear. Star, is it fine? Can you relate it with the example we have discussed, ITC and FMCG as the star? Okay. Then next is a question mark. A question mark is the product in a high growth market, okay, but holding a relatively low market share. Okay. Can you think of examples? Question mark, high growth, but relatively a low market share. Think about, I have an example in mind. I want you to think and tell me, what could be examples of a question mark? I'm not talking about ITC. ITC's 3 strategic business units we have classified. Think out of the box, something out of ITC. Think, what could be a question mark product for any company? Let's see. Yes, new products, but what new products? Wow, Shalya, I think our wavelengths are somehow matching. I was also thinking about electric vehicles. Yes, so think about electric vehicles, okay? They have high potential in today's environmental conditions. Electric vehicles, they are gaining a lot of momentum, okay? So it has a high growth market, but relatively a low market share. People, they are still buying petrol and diesel cars and vehicles. Okay, today we have also Ola electric scooties, right? But the market share, can you think it will be like very big as compared to Honda Activas or the other scooties which are there? Its market share, its relative market share will be very small, but it has a very high growth market considering the overall environmental awareness among the public. Okay, a question mark. So electric vehicles would be a question mark. Will they require expenditure? Will the electric vehicle segment require expenditure? High expenditure? Yes. So when they want to convert this question mark maybe into a cash cow or into a star, they will have to incur heavy expenditure. Considerable expenditure may be required to turn a question mark into a rising star or even a cash cow. Consequently, they tend to be poor cash generators and show a negative cash flow. So I'm sure if you look into Ola electric vehicles P&L, just that product's P&L, it will be negative because they would have spent enormously on research and development. Can we identify, Shalya is asking, can we identify question mark as an opportunity? Yes. It is something you need to work upon, not an opportunity. It will be it could be a strength because a product is internal to a company. No? So I will consider it as a strength which I need to work upon. Okay. So that is something a question mark is. Okay. That there is a potential in that product. You need to work on it so that it becomes a rising star, or is it to be a cash cow? How it can be converted into cash cow? It is already having a high market growth. Okay, so maybe when just you can imagine a time that will come for electric vehicles when the market share will become very big, because all the public, they will start changing their preference from conventional vehicles to electric vehicles. Okay, then the growth potential, so now maybe the growth is in terms of hundreds of percentage, maybe a 300% growth is what they are currently seeing year on year. But then there will come a time when the growth may come down, but then there will be high market share for let's say if you're talking about Ola electric vehicles, then the market share will be high, but the growth potential that would have come down by that time, because we're talking about conversion, right? When that conversion happens, it is a possibility that the market growth would become low. Understood? Yes, Amit. Okay, so these were stars and question marks. Then next is cash cow. Cash cow is very simple. Cash cow hold a high market share, in a low growth market. They generate more cash than they incur, and so can finance the growth of rising stars and question marks. So what the cash it generates, the cash cow product, that is used for expenditure required. So we discussed, right? Stars also require heavy expenditure. Question marks also require heavy expenditure. Where will that money come from? That money will come from cash cow business. Okay. And that cash cow business is what? Something which is generating more revenues than the expenditure. They generate more cash than they incur, and so can finance the growth of rising stars and question marks. Clear? And finally, we have a dog. A dog is a product with low market share and low growth market. They are often allowed to die. That means the business is shut down. Okay. Often they are cash cows, fallen on hard times, and unless that trend can be reversed, they should be allowed to die or be killed off. Okay. So that is a dog. A dog is a, can you think of example? Here, Tanya says, ma'am, for Apple, can we say iPhone as star? Okay. iPad as cash cow, question mark is MacBook, and iPods as dogs. I mean, before I read your example, I was just not thinking about all the other products, but I was thinking about iPods. That yes, iPods would be dog for Apple, because they were a cash cow at a point of time. iPods were so popular. Even I had one small iPod at that time when I was a kid. So they were very popular at that time, but now they have died off. No one carries an iPod. They listen to music on their phones only, right? So they are allowed to be killed. And then for other products which Tanya has called out, let's try to analyze. So Tanya is doing the BCG metrics for a Apple company. For the Apple company, let's see. So she says that, ma'am, iPhone can be star. iPhone can be star. Let's see. It has a high market share. Does it have a high market growth? Yes, it has a high market share. Agreed. Apple's, they occupy a good chunk in the market. Maybe Apple is the leader and then Samsung comes next, or maybe Samsung is the leader or Apple comes next, something like that. So yes, it has a high market share, but does it have a high market growth? Doubtful. So what my mind says that we could classify that as a cash cow. Okay. Then next product, Tanya says, is iPad. iPad. This is something. iPad would be having high market share, yes, high growth potential. Because now this could be a high growth market, Tanya. Why? I'll tell you. Because of the change in the mode of studying. Earlier, everyone used to study through pen and paper. Now that mode has gradually shifted. Now, maybe not for the senior students, but for the younger ones, parents, they buy tablets for their phones. And for the student, I mean, for the children. So it is a high growth market. The growth of iPads could rise because of the change in the mode of education. So I will put iPads as stars because yes, they have a high market share first, and then there is a high growth potential. Okay. Then third product which you said is MacBook. MacBook. I don't think its market share is very high. Okay. So it has a low market share, but it again, same for the reason of change in education mode, there is a high growth potential for laptops. So yes, it could be a question mark. And dogs we have discussed, iPod is the dog. So this would be the BCG metrics. I believe 2 classification you did was correct, but just between iPhone and iPad, I feel iPad would be the star and iPhone would be the cash cow. It is generating enormous amounts of cash for Apple, iPhone. So it is definitely a cash cow. It doesn't require as much expenditure. Do you think the company would be spending more than what it is earning from Apple iPhones? No, it is definitely generating more revenue because stars are something which require more expenditure to get that high market share and get that high market growth. So iPhone will definitely be a cash cow, not a star, because it is generating more revenue. I've got more examples in the chat box. Let me see that. Simmer says Mario games or video games. Yes, that could be a dog. But I don't think video games will be allowed to be killed off because it is some entertainment source, right? So I not say it is something to be killed. It could be. The trend could be reversed. There was a time when young children used to play a lot on video games. Now they play on their phones only directly, or they watch YouTube videos or some of things which young kids they do these days. So not very clear on classifying Mario games as a dog. Okay, then Amit says memory cards used in ports. Yes, no one puts extra memory cards these days. Earlier there used to be this chip-like thing we used to put in our phones. Now it's no longer there. Okay, it's a dog. It has been allowed to be killed off. Then Maruti's older models, yes. Older models, they are being scrapped because Maruti 800. You will hardly see. I don't think company even sells Maruti 800 these days. Okay. So yes, older models they are allowed to be scrapped because newer versions have come up. People don't want to buy those older models. Okay. Ayush says, with passage of time, suppose iPhone 6, which was a star a few years back for Apple, which category would it be currently when we have iPhone 13 as the star? Okay. So you're asking about iPhone 6. It will be in dog category, Ayush. It will be scrapped off. Maybe in a few months even. You will not find that product anymore. So it will be a dog. Then Amit says scooters as replaced by scooties. Yes, there was a time when there was a Bajaj scooter. You used to run with that scooter to start it off. Will you now see those Bajaj scooters? No. Now scooties have come. They have that electric start button. So that has been replaced. So those scooters, the earlier Bajaj scooters, Hamara Bajaj, they are now dogs. They have been allowed to be killed off. She says, star product can become cash cows with passage of time. Yes. When it will stop requiring that much expenditure now, that to get that high share, then it will become a cash cow. It will generate more revenue than it requires the expenditure. A company focuses a lot on its cash cow. Okay. So like in all the companies, they identify that this line of business is something, it's giving me cash. I will keep on using the money it generates in other lines of business so that I can grow them. Okay, so it's like it runs on autopilot mode. Cash cows of a company, they run on autopilot mode. It will keep on generating the cash and, it will be used, that cash will be used for the other products. So ma'am, which is the best category, cash cow or star? For which one are you asking, Tanya? Which one is the best category for any company? Okay. See, we will talk about it. A company decides its plan of action separately for each of the types of products. For dealing with a star, how it is going to, what action it is going to take, we are going to talk about it. A company lays focus on all three. Question marks, cash cows and stars. You can't pick up the best. It's just that the mode of action differs. Cash cow, as I said, it will run on autopilot mode. It will keep on generating the cash because you have put in that hard work earlier. Now it is a cash cow, it will keep on giving you money. And then you will put efforts more in stars so that ultimately it becomes a cash cow. Okay. Ayushi says, so company should support the growth of star product by using the money generated from cash cow. Absolutely, yes. Even also for question marks, Ayushi. The money generated from cash cows will be used for stars and question marks. Okay. See, yes. So that was about the introduction to the BCG metrics, very important topic. The questions which come in exam will not clearly call out, use the BCG metrics to analyze. But if you are smart enough to realize the exact question is talking about multiple products, may not be 4 always, they might even just be talking about 2 products. But you are able to get that hint that they're talking about market share, they're talking about market growth, using the words like cash cow, a dog, as per in the bracket, as per BCG metrics. It is going to get you those brownie points. Examiner will understand that you could relate it without specifically asking for it. Okay. Sima says, while considering market growth, are we considering the potential of having high or low growth, or we are considering the companies who are already having high or low growth? I would say it would be potential, because it is a high market growth. That is why it is requiring high expenditure. Civil. So that is why you have to think that yes, it is in the high growth market industry. Overall industry, how is it posing? Is it a high growth or is it a low growth? So there are some conventional products like soaps. Do you think it will be a high growth market? No. But if you're doing something new in the soap business, then it will get considered that yes, the customers are picking up this product. Then that will become high growth markets. Amit says, are we going to make plans? So I think it should be potential. Yes, it is. It will be potential only, because then only you will decide your plan of action now. Then so that it becomes ultimately a cash cow for you. Okay. Okay, then let's see what are the uses of BCG. If you have any more queries, you can always put it up. No worries. I'm just moving to the next topic. In the meanwhile, if you feel that I haven't understood anything, you can feel free to put it in the chat box. Okay. Uses of BCG analysis. Internal balance should be checked. Why are we doing BCG analysis? Just for fun to classify something as cow or dog? No. But the reason is it ensures a proper distribution of resources between products. Example, largest should be stars or cash cows. The employees which will be working on different businesses, you will put the best of the employees in stars or cash cows. So that, because it is the thing which is going to ensure that the company survives in the long run. Okay. So proper distribution of resources will be done according to the BCG analysis. Sufficient cash flows from cash cows repay finance. Repay finance means if you have taken loans, now the money which will be generated from cash cows can be used to repay finance, and they permit investment in question marks and stars. This we already know. There should be a sufficient successor product and service to replace declining star and cash cows. You know, a declining star is what becomes cash cow, and then a cash cow might also become a dog. We studied here, right? That a cash cow fallen on hard times becomes what? A dog. Once upon a time, iPod was the cash cow for Apple, but now it has become a dog. So there should be a successor planning. Like you would have studied in the olden times when there was the rule of kings and everyone. They used to plan their successors, that after me, this is the person who is going to sit on the throne. Similarly, a company will plan its products. That now I think iPhones they are becoming redundant. There might come a time when iPhones also become redundant. They become a dog. Then which is the product that is going to replace it as a cash cow? Which is the product that is going to become the next star for the company? That planning is done on the basis of BCG analysis. So first one is proper distribution of resources. Then finding out the resources which need to be invested in question marks or stars, and finally that it helps you to plan the successor products. Okay, so that is the usage of BCG analysis. Any doubts here? Is it fine? Okay. Then assess trends by mapping metrics at regular intervals and superimposing on earlier matrices to reveal direction and momentum of each product. This is also a usage. Okay, what it is trying to say, you keep on preparing the metrics. It's not like a one-off exercise that I prepared my BCG metrics of Apple in 2008. Now, this is the fundamental BCG metrics. Nothing is going to change about it. It doesn't hold like that. What happens is that BCG metrics is developed maybe at yearly intervals. That after 1 year, what is the current position of my products? So it's an ongoing process. So it is saying that when you are doing BCG analysis, it helps you to map it and find out the direction and momentum of each product. That earlier iPod was a cash cow. Year on year, it changed, and then ultimately it became a dog. Okay, so it helps to reveal direction and momentum for each product. That is also a usage of BCG metrics. Then evaluate competitors by creation of portfolios based on their products or business division. So you can find out the efficiency and efficacy of competitors by doing a BCG analysis. Okay, that year on year, see, let's say when I'm planning, plotting the BCG metrics, and find out that my growth market share was 43%. It has grown to 53%. It has grown to 77%. So what does it mean? The competitors, they are slowly losing their position in the market. Okay, so by doing a BCG analysis, you can evaluate your competitors by creating a portfolio based on their products or division. So like you do your own BCG analysis, you can do BCG analysis for their products also. Like what is the current focus? So don't you think HUL can do BCG analysis for ITC? Obviously it cannot, so it can evaluate its competitors' position. So it will see my market. If I am seeing a high growth, what does it mean? That maybe ITC, I'm sorry, I'm talking about ITC as primary example and then HUL as a competitor, right? So then I will see that HUL will also, I can prepare the BCG analysis for HUL to see how its market growth is, how its shift of products in its portfolio is happening. So I can do the evaluation for HUL, right? Then next is evaluate risk by adjusting portfolio to reflect impact of hypothetical scenarios or changes in key environmental variables. This can be accomplished by sensitivity analysis. What does it mean? So sensitivity analysis is also a topic in the curriculum. Sensitivity analysis, let me give you a brief description about it. I'll come to Excel. So whatever I write in the class in Excel, now I put that as one tab here, scribble. Sometimes important things can also be written here. So whatever I discuss in the class in Excel, I just add one tab in the files, Excel files, which I'll be sharing across with you as scribble in all the chapters, chapter notes and findings. Okay, sensitivity analysis. What does it mean? Basically, so if you have given you one general example right now. So you found out, okay, revenue, costs, profits, oblique, cash, no, profits before tax, tax, and PAT, profit after tax. Okay. So revenue is 100, cost is 40. This is 100 minus 40, 60. Tax is, let us say, 30% into 0.3. I get 60 minus 18, 42. Okay. So this is my small P&L. When I'm doing, I'll call this PPT. When I'm doing a sensitivity analysis, and this is actuals, and this is the forecast for the next year. I find out that the forecast would be, and I have to achieve. So I'm doing a upward forecasting. I want to achieve a profit of 60 next year. Okay. So tax, I'm assuming it to be the same. So this will be what? 0.7 into 0.3, 25. I'll take a round number. Okay. What do I take? Let's take 70, 70, 30, 100, and costs, if I'm preparing on the basis of same standard, $66, and this will be okay. This is what I want to achieve in the next year. This is a forecast. Is it something written in stone that this is what will happen next year? It can change. So what is the sensitivity of this profit to various factors? So when I'm doing sensitivity analysis, let us say I will take multiple situations. First assumption 1 is sales, they are down by sales. Let us say in the next year, they are down by 5% as compared to the forecast. So what will happen in that case? Let me just copy it so that I don't have to write the formula again. In that case, my sales would be into 0.95, right? Cost will be same. Cost is not changing. It's just that the sales have fallen in comparison to the forecast. Rest, this is what 158 minus 67. This is 30% tax and 92 minus 28. So my profits, they have fallen to 64. What does it mean? That my profits are sensitive to obviously change in sales. How much the profits have fallen? The profits have fallen by 8%. Okay. So a change in sales by 5%, my profits have fallen by 8%. This is the sensitivity of profit as compared to the change in sales. Clear? So this is number 1 assumption. Shalya, how did you calculate 6%? It will be 8%, no? See? I did 64 by 70. 6 rupees. Yeah, 6 rupees only. That is what I'm going to get. The fall has been 70 minus 64 divided by 70. I'm getting 8 only. How are you getting? Oh, okay. Got it. No worries. So you are saying in rupee terms, you are getting a fall of 6%, 6 rupees. That's okay. But let's talk in percentage terms. So a 5% decrease in sales led to a 8% decline in profits. Likewise, I can change anything. Assumption 2, if I take assumption 2, if I'm taking, this is how sensitivity analysis is actually done. Okay. Assumption 2 is tax rate increases to 40%. Then what? So everything will be same. Tax will be what? Into 40. Profits have become 60. So I'll say 60 by 70 minus 1. 14% decline in profits because of a 10% increase in taxes. So are you getting the feel of what sensitivity analysis is? A change in one variable because of a change in another variable, right? Percentage change in single variable that would be needed for NPV or profit to fall to 0. Yes, that is what you would have done in AFM paper. Yes, Ayushi, that was one of the topics we studied in AFM. That what happens, what is the change in sales that could happen such that the profit becomes 0. So there are multiple iterations of sensitivity analysis. Okay. So if the sales are down by 5%, then what is the change in profit? Now, if I say by what percentage the profits, the sales would have to fall such that the profits become 0. That was for NPV questions. That is also doable. But just to give you a feeler of what sensitivity analysis is, these are 2 examples. Are you clear? Have you understood what sensitivity analysis is? Because of change in one variable, what is the change in another variable? Because profit is also derived from sales cost taxes, right? So if one of the variables is changing, then what is its impact on profit in our example? Is it clear, everyone? Okay. So coming back to the slide, what is it saying? Where were we? Yeah. When I know that one of the products is very sensitive to even a small change in sales, what will I do? I'm going to classify it as a high risk product. Let us say that product is a cash cow. So I will classify that product as a high risk area, that sales is very risky for a cash cow. If its sales go down, then it will not give me money for other businesses. Okay. So evaluate risk by adjusting portfolio to reflect impact of hypothetical scenarios. What I did was hypothetical only. Let's say the sales fall by 5%, the tax rates increase by 10%. So to reflect the impact of hypothetical scenarios or changes in key environmental variables. This can be accomplished by sensitivity analysis. So when I will have done the sensitivity analysis for the different products in the BCG matrix, I will find out which ones are the risky products and where the focus needs to be. Okay. See, basically, whatever we are studying now, it helps us to decide our plan of action, that what needs to be done for that particular product, for that particular business unit. So that is helped by BCG analysis. Clear? So uses you have understood. What are the uses? Distribution of resources, planning the succession of products, then direction and momentum of each product. You evaluate your competitors by doing their BCG analysis. So this is something you can put in your answers. Imagine there is a scenario given to you. They are talking about a competitor. You can suggest that, one of the statements you could make, we could evaluate the competitor XYZ, whatever is given, by using a BCG analysis, so that the company gets to know where its position is in the overall market. Okay. So that is the uses of BCG metrics. The next topic is the BCG metrics and performance measures. The different characteristics of business units in each of the quadrants mean that different financial performance measures are likely to be appropriate, depending on the business unit's position in the market. Yes. So as I said, for each quadrant, we will be defining a different plan of action. So if we are defining a different plan of action, obviously the key performance indicators which we are going to use to measure the performance of each product, that is going to be different. So let's see what's given next. Metrics for business units in high growth markets should be based on growth. Example, I give you one example now. Year-on-year growth in sales. Example, revenue growth, profit growth, and relative market share are likely to be important. So for business units which you are classifying in high growth markets, what are you going to measure for them? You are going to measure what is the revenue growth for that product or for that business. What is the profit growth for that business? So that you know that these are high growth markets, and yes, they are actually qualifying the definition of high growth markets by measuring revenue growth, profit growth, and so on and so forth. Then next is metrics for business in low growth markets. In particular, cash cows should focus more on margins and cash generation. So when you are going to measure the performance of cash cow, what will you measure? That how much cash is it generating? So it should focus more on margins and cash generation. For cash cows and dogs, cost control is likely to be an important issue in preserving the profits, indicating a need for performance measures looking at cost and cost control. So for products or business units classified as stars or question marks, meaning what? High growth markets, you will focus on performance metrics which measure growth. What could they be? If you are asked to suggest an example, revenue growth, profit growth is what you can give. For metrics usable in low growth markets, what will be low growth markets? It could be either cash cow or dogs. You will try to improve or increase the cash generated. How can you increase the cash? Either by increasing revenue or by reducing the cost. So for cash cows, you will be cash cows as well as dog, you will be focusing on reducing the cost outflow, so that maximum of the cash which is being generated can be used for other lines of business. Okay, so your metric for evaluation could be cost percentages or quantum value of cash outflow on account of costs. These are the metrics which can be used in low growth markets, right? Is it clear so far? Any doubts? Is it okay? Can I move to the next slide? Okay, great. So I have an activity for you. So I'll start reading the activity, right? DEF company is a large company which has 3 divisions: a restaurants division, a pubs division, and a casino division. And no one pointed out that I should be reading the requirement first. Where are the active students? Why are we not reading the requirements, waiting to be stopped? No one stopped me. As I told you yesterday, please make it a habit to read the requirement first. You should know what you're trying to find out. Okay, just by reading this question as a story, it won't help, right? So I'm going to deliberately make sometimes mistake, and I might genuinely make mistake of starting to read the question directly. Please stop me and tell me, ma'am, to read the requirement first. Okay. So requirement, what is it? Analyze the divisions according to how they fit into the BCG matrix and comment on which performance indicators may be relevant for each division. So there are 2 parts in this question. First is you analyze the divisions, and then second is you comment on which performance indicators will be useful for each division. You are given with a lot of data. You'll have to suggest, like we just saw in the previous slide, for a high growth market, which metrics can be used, for a low growth market, which metrics can be used. So for this company having 3 divisions, you'll have to suggest them. Have you understood the requirement? What do you have to do? Is that clear? Okay. Then let's read the question. DEF company is a large company which has 3 divisions: a restaurants division, a pubs division, and a casino division. It is operating in an economy where growth rates of more than 5% per year are considered to be above average. The company's management accountant has prepared the revenue information about the divisions. For restaurants, first of all, DEF, like for the company, DEF is the name of the company, right? We are analyzing. This is the revenue and the 3-year forecast is given to you. Market sector is of $10,200 million. This is forecasted to grow up to $10,350 million. Then market leader is having a revenue of 295 and has a forecast of 305. This is given for the restaurants division. Then for pubs, similar information: DEF, market sector, and market leader. See, It's given here that in pubs, DEF is the market leader. So do not make mistakes here. I have explained to you what relative market share and all is. Okay, you will be solving it on your own. And then they have given the same data for casino, DEF, market sector, and market leader. And I said, read the requirement again. Analyze the divisions according to how they fit. What are the three divisions? Restaurant, pubs, and casinos. You have to classify them as per the BCG metrics and comment on which performance indicators may be relevant for each division. It's of 9 marks. Take your time. Give me good answers. This one is very, very interesting and helps you to apply the concept which we have just studied. Will you be able to do it? Don't, any one of you, please don't sit idle in the class. It's your time. If you're not practicing, you're wasting your own time, not mine. So no one will sit idle. Okay. So everyone, please take a screenshot of this screen. Okay. Press on your laptop, Windows key, Shift and S together. Windows, Shift and S. Press them together. Drag the rectangle around this part. Windows, Shift and S. Press on your laptop. Drag the rectangle around this part and go to your Word or Excel, wherever you are going to prepare the answer. Paste it somewhere. Why? Because what I'll do, I will keep this on the presentation mode so that you can, solve completely. Have you understood? Please take a screenshot here, Windows, Shift and S. Save it anywhere. You can delete it later. You will definitely get the slides. Don't have to save anything for future. Just for solving purpose, take a screenshot right now and try to find out the answer. And let me know when you're done. Just message me done in the chat box that you have taken the screenshot. And so that I can present the next slide on the screen. Chaldia says done. Others, everyone please take screenshot. No one said idle. Tanya is done. Ayushi, Amit, Harita. Harita is very silent today. Simmer and Tanya is done. And Simmer. Please let me know when you are done taking a screenshot. Windows, Shift key and S. Press it together, drag the rectangle, save that and go to any Excel or Word file, press Ctrl V. You will paste it and then you can save it for solving the question just now. You can later delete it. You'll get the slides. I'll keep this on the presentation. So try to find out the answer. First, you have to classify and then you have to give me indicators, performance indicators, which can be used for each division. And here, and you can post your answers in the chat box. Ayush, I just read your query. You wish to connect for planning your ACCA preparation. Could you please share a contact? So are you part of the APM group, Ayush? Have you registered? I think Sandeep would have added you to the group now. I'm not seeing your contact there. Are you there in the ACCA APM group? So Ayushi has shared the answer. Let me read it. And she says restaurants are dog. Business units with low relative market share in low growth market and metrics in low growth market should focus on margins and cash generation, and company should focus on cost control to preserve the profit. Okay. Pub, she says, is a cash cow and is the market leader with high relative market share of more than 1. In low growth markets of 0.5%, and metrics in low growth markets should focus on margins and cash generation, and company should focus on cost control to preserve the profit. Okay. Casino, and she says a question mark unit with low relative market share of 60% in high growth market of 22%, and metrics for high growth market should be based on growth and company should try to maintain its market share. Well done, Aishi. Good planned answer. Others, please share your views. And Ayush, I said, are you a part of the APM group? Chaldia says restaurants, low market share, good, low market growth. Pubs, cash cow. How have you classified restaurant, Chaldia? I can't see it. Pubs you have classified as cash cow, okay. And casinos as stars, okay. Okay. Try to improve your answer, Shaldia. Like, what could be the performance indicators we discussed in the previous slide, no? For low growth market, what it should be, like that. Try. And others, please try and share your answers. Please post your answers in the chat box when you're done. And shall I try to improve your answer? You've just mentioned what would be the market growth, market share. try to build on that answer, because APM answers, as you have seen, they are carrying a lot of marks. You will have to develop that habit, how you would write in an exam. Okay, try it. So I've got multiple answers in the chat box. Let me see. Shalda has further elaborated the answer. Shalda says, since restaurants are falling under low market growth and market, they should try and generate more cash of them by either by increasing profit margin or reducing cost. Okay. Then for pubs, since they already have market share, we should milk them for profits and reduce costs and further invest the cash inflow into casinos to grow them further and exploit the advantage of market growth. Casinos are stars as they have 22% market growth with 60% relative market share. Companies should utilize spending to make casinos as cash cow. Pubs are cash cow as they have low growth of 1%, but high relative market share of 100%. Yes, okay. Company shall use the cash generated from pubs on casinos, which are stars. Restaurants are dogs as they have low market growth of 1% and 33% relative market share, which is comparatively lower. Hence, company should carefully spend on this unit. Okay. Others, should I show the model answer or should I wait for you? Should I wait for some time? Should I show the answers, everyone, or should I wait? Let me know. If you want me to wait your drafting or answer, I'll wait for some time, or I'll go ahead. Good attempt, guys. Those who have answered, very good. No one is responding, so I'll just present the answer. Okay. I think there is slightly an error on your part to calculate the market growth. I'm seeing that in most of the answers. Let's see how you are doing it and how it should be done. Market share, you all calculated correctly, that it should be that company's revenue versus the market leader's revenue. So you get that the market share is low, about 0.3, or you are calculating 33%, that's okay. So that's 0.3. Market growth is also low. The market sector is only forecasted to grow by 1.5%, which is 150 by 10,200. How is this coming? See, what do you mean by market growth? The growth it will see over the years, right? So from 10,200, it will become 10,350, correct? So 150 over 10,200 will be how much? It's coming as 1.5%. How are you getting something about 1%? Some different calculation are you doing? Yeah, Ayushi, you are right. But someone gave me 1% also. Let me see, who was it? Shalda, you gave me 1%. Then, yeah, Ayushi, you gave me correctly only. Tanya gave me how much? Tanya also gave me 1%. How are you getting 1%, Tanya? See, let me present here again. 150. You saw that, right? From 10,200, it became 10,350. You're talking about market growth, no? So market, how much is it growing? You don't have to see the growth in DEF. You're talking about growth in the markets. 10,350 minus, you're doing 10,350 divided by 10,200 minus 1. It's coming as 1.5 only. I think you're doing rounding off maybe. Oh, that was right. Just take it up to 2 decimal places. Okay. Or 1 decimal place, 1.5, because a market growth of 1% and 1.5% is significant. So that is why I was a little confused. Okay, if you're calculating it like that, then it's fine. So 1%, 1.5% is what you would be getting. So relative market share is low, about 0.3 or 33%. Market growth is also low for restaurants. The market sector is only forecasted to grow about 1.5% over 3 years. The restaurant division should be classified as a dog. You all classified. Performance indicators. So it's a dog. It will be talking about curtailment of cost and cash generation. Performance indicators for business unit in low growth markets should focus on cash generation, or you can write curtailment of cost. That's done for restaurants. I think a few of you answered very well here. Then next, pubs. DEF is the market leader. So its relative market share must be greater than 1. You cannot calculate the relative market share because it was not given who is the next one after pub, DEF. So we will say that it will be greater than 1 only because the market leader's sale by definition must be higher than any other entities. So you are saying that the market share is greater than 1. Therefore, the pubs division's relative market share is high. However, market growth is very low. What was the growth in the market? Forecast growth in the market sector is only about 0.5%. Like 50 over 9,500. How did I calculate that? Come back to the slides. See, market is growing from 9,500 to 90,550, 9,950, 550 in 3 years. That's just $50 million increment over 3 years and on a base of 9,500. So that gives us about 0.5% growth in 3 years, while DEF's own revenue is actually expected to decline slightly over the 3 years. Okay. The pubs division should be classified as a cash cow. Performance measures are likely to focus on profit margins and cost control. Okay, same way, like cash generation and cost control or cost curtailment, that you would try to reduce the cost. So same here also. Any doubts in restaurants and pubs? Fine, I guess most of you gave me correct answers here only. No errors. Those of you who answer, those of you who did not answer, I cannot evaluate you. If you are having any doubt, please let me know. And let me know why you're not answering. It was a simple, basic question, a concept which we just discussed. I got answers only from, let's see whom, Tanya, Shalya, and Ayushi. Only 3 students answered. Now, where are Amit, Harita, Simar? What about you guys? Don't want to type? Or didn't understand? Didn't understand, then it's a big problem. What happened, Amit, Harita? No doubt. Then why did you not answer? Please be interactive in the class. You know what it helps me to do is that when I read your answers, I understand your viewpoint. And it's for your own best, you will get personalized feedback. What's better than that? So please share your answers so that I understood what you are understanding. Okay. Then casino. So there was, most of you said that it's a star. It has the potential to become a star. So you can write like that. Okay. So what it is saying is relative market share is 0.6, 150 over 250. So while it is still low, it is not as low as the restaurant division's market share. Okay. Here restaurants, what was the market share? 30%. But so as compared to restaurants, we see that yes, it has a relatively higher market share. Market growth is high. The market sector is forecast to grow by 22% over 3 years, and DF's own casino division is forecast to grow even faster than the market. So what the question is doing, see, have a look at the slide. It is calculating the growth in the market, that is 400 by 1800, and also it is calculating the growth in its own performance as if 45 by 150. So if we do 45 by 150, let me do 45 by 150, that's 30%. Okay, as compared to market growth of 22%. So basically for casino, it's growing very fast. Okay, so it has a high market share and also a high market growth. Okay, so coming back here, the casino division is currently a question mark. Now, ma'am, why a question mark? You will say it's okay. You don't want to recognize it as a question mark, but have a look here at this graph. What are question marks? Low market share and high market growth. So all of you will conclude that yes, it has a high market growth. In fact, its own growth is higher than the market growth. So definitely it has a lot of potential. But market share, I said that there is no clear demarcation in the BCG metrics that this is high, this is low. It's all right to call it a star, or you could say that it is a rising star, because if you look at the answer now, what was the market share we were getting? We were getting a market share of 60%. So while it is still low, it is not as low as the restaurant. So it's okay to classify it as a star, but you can also call it as a question mark and a potential to become a rising star. Because market share is not higher than 1. Are you understanding the point I'm trying to say? Relative market share is high, but it's not higher than 1. So that is why that confusion is arising whether to classify it as a question mark or as a star. If it is very close to 1, like 0.8, 0.9, then it's okay. Then you can call it a star. But because it was 0.6, we are calling it a question mark. Is it okay? Everyone, did you understand? I'm not saying your answers are wrong, but I'm saying it would be better to call it as a question mark. Why? Because the market share is 0.6. Okay. Yes, that is why. See, if you look at pubs, what was it? It was higher than 1. So it was clear cut that it has a very high market share. Okay. Shalya says, so since it's not a market leader, we can call it a question mark. Yes, that's what I'm suggesting, Shalya. That since it is not as, so even if not higher than 1, but maybe if it would have been like 0.8, 0.9 or 0.95, then also I would have said that it has a very high market share and I would have called it a star. Because it is 0.6 now, that is why I'm saying. So as compared to the leader, you are just 60%. You're not the market leader. So that is why I'm not calling it a star as of now. Okay, Tanya and Chalya and Ayushi. So Tanya says, so ma'am, can we say stars market share should at least exceed cash flows market share? You can call. I mean, from, like having that exam awareness point of view, I would say yes, that would be a clear cut indicator. That if the question has given you cash cow data also, and you see that they are, I mean, it's clearly given that it's a market leader or it's very high, you can, I think that will get a little confusing, Dania, what you are suggesting. I would say take 0.8, 0.85 as the benchmark. That if it is higher than that percentage, now call it a star, otherwise consider it to be a question mark. It would have been much easier if the academic, people, they would have said that consider this as the benchmark 0.5 or higher than 0.75. But because it is not there, we have to make this judgmental call. Then we can say that above 0.85, it's a star. Below that, it's a question mark. Because for a cash cow, it will always be higher than 1. No doubt about it. They clearly make it clear that yes, it is higher than 1. So you can call it a cash cow. But for question mark and star, it becomes a little difficult. So you can consider 0.85 as the benchmark in exam. That since the market share is high, close to 1, it is a star for the company. The casino division is currently a question mark, although if it continues to outperform the market, it has the potential to become a rising star. Performance indicators for business units in high growth markets are more likely to focus on growth, right? It is in a high growth market. So what will be the performance indicators you will be considering? Revenue growth, profit growth, and relative market share. That what has been the change in the relative market share. So currently you are at 0.6. Then you will grow to become 0.75. You will grow to become 0.85. And then you will become a star ultimately. So this is a performance indicator which you will be measuring to track the performance of casino. Okay, so you've classified all 3. Restaurant as a dog, and what will be the metric? Cash generation or cost control also you can say. Then for pubs, you can say it is a cash cow, and then you will focus on profit margin and cost control. And finally, we have casino. It is currently a question mark, has a potential to become a rising star. So you will be focused on its profit growth, revenue growth, and relative market share. Okay, this was a very interesting question. It actually tests how much you have understood this concept. Okay, most of you gave me correct answers, almost. Okay, so that's fine. You'll improve with the practice we are doing. And then I think we can take a small break here. It's 12:10. Let's take a 15-20 minute break and catch up at 12:30 approx. Does that work? So eat something, take a small walk and get refreshed and be back to the class. Thank you so much. We'll see you after the break. Hi everyone, welcome back from the break. Let's continue our discussion on strategic models. We have covered SWOT model and we have covered the PCG metrics. Then the next model which we are covering is Porter's generic strategies. Again, something which is very highly examinable in the exams topic. They don't ask you directly, but this one topic, cost leadership and differentiation and focus strategy, which the examiners usually hint at while they are framing the scenario. Okay, so let's see what these strategies are. So Porter gave strategies to companies to be adopted for their products, what they can do. Okay, so first one of them is cost leadership, a strategy in which firm seeks to be the lowest cost producer in the industry as a whole. Can you give me one example which comes to your mind when we talk about cost leadership, meaning a company which gained leadership because of the way it priced its product for the customer? Absolutely right. That is the example I was wanting to hear, and that is Jio. When Jio came in the telecom industry, it gave like 0 rupee plans, right? Or maybe just minimal, I don't remember it very clearly, but it was to penetrate the market, to enter the market, to dismantle the existing players completely. There was a time when there were so many players, right? Like Tata, Docomo, Idea and Vodafone now have merged. Then some what was it? I'm just forgetting the name. There were so many players, yeah. So many telecom providers, but now when Jio came into the picture, it used the cost leadership mode, meaning it priced its product so low that the existing players, they are asked, I mean, they are pushed to revamp their strategy. Because it was only after Jio came, then Airtel priced its products. There was a time when 1 GB data used to cost so much. It was considered to be some royalty, an elite thing to have, that I have got data. And now see, we are conducting our classes, 4-5 hour classes on using network, right? That is how Jio just completely revamped things. Okay, now it is into not just into telecom, it was into fiber services, then Airtel, and then Vodafone. So there are just 3 players. Then BSNL is also there, but obviously majority of the chunk is with these 3 private players. But who led the change in telecom? It was Reliance Jio. Okay. So example would be Reliance. Then second strategy. So Porter said either you follow a cost leadership strategy, that means you produce the lowest priced products, or you differentiate your product. Differentiation, a strategy in which a firm seeks to gain a competitive advantage through the particular characteristics of its products or processes. Can you give me an example? Because of the way it has some features, it is different from the other players in the industry. Tanya and Aishi say Apple, Shalda says Starbucks, Samsung. Okay. I would go with, all of them are correct. We can discuss about Apple's example. So Apple's features, so they are considered to be very secure phones. Then the camera quality. So they led that in the market, providing such premium features in a phone. Who thought so many things would be done in a mobile phone? Remember, there was a time when there used to be cordless phones, these big phones you had to carry around. And then slowly and steadily things changed. Then there was this big Nokia phone that came. You could play games and call. And now there is nothing which can't be done on a mobile phone. You could be attending classes also on a mobile. So this change was brought by Apple and Samsung primarily. Both of them, they had their own roles to play. So they followed differentiation policy. Okay, they gained competitive advantage by using such characteristics which others did not possess. In fact, some of the Apple features, none of the Android phones have. Some of the Android features, Apple phones don't have. So the market leaders, they have created a niche here because of their own features. Something which others don't have. Okay. Then, like currently, let's take a recent example. Recently, you would have seen Zomato Intercity Legends. Have you seen that? Intercity Legends on Zomato. Yes, what does it do? It is using, it is providing the service of giving some intercity items at your doorstep, right? Like what was this? Biryani and famous sweets of Kolkata. So who thought something like this could be possible? So Zomato brought up this idea. Actually, it was something which came on Shark Tank. A couple had brought up this idea on Shark Tank, and then after a few days, Zomato launched it officially at a large scale. They were doing it on a small scale, but Zomato picked up that idea and brought it. Now, this is a feature which only Zomato is having. Swiggy does not. Its main competitor is not doing it as of now. Maybe it will do it in future. So it's a differentiation strategy which Zomato is following. Okay. You can take a lot of examples in both these generic strategies. Most of the companies follow one strategy or the other. Amit says, can Google also be said to be using differentiation as compared to other cloud storage providers and mail providers? Not really. Not really. It was a leader at one point of time. Google was the one who, Google and Amazon actually both. Amazon is also a cloud service provider, which is having a major market share. And mail providers, there are a lot of other mail providers which are there. Yahoo, at a point of time, it was leading the markets. At that time, even Gmail was not that popular. Earlier, everyone used to make IDs on yahoo.com, but now Gmail brought so many new features. It has now become their strategy. Differentiation is what has, the leaders using this policy. Another reason, actually, the major reason why Google succeeded is because of the large portfolio of interrelated services they are offering. Using just one email ID, you get access to so many apps of theirs, right? Be it Google Map, Google Photos, Google Drive, then Google Sheets. So they have provided so many products in their portfolio that no other company is providing together. Like Microsoft is providing some services of like Excel, then Word documents and everything. And at the same time, it also has Outlook, but its features are not as good as Google. So somewhere down the line, their mix of products in the portfolio helped them to achieve the position they are currently in. Okay. So yes, we can say for some of the products, the differentiation strategy worked, but what really worked for Google was the, whole portfolio of products they offered on just one identification, and that was the email ID. Okay. And then, so these are the two generic strategies which Porter came up with. And then with time, there came another strategy, and that was the focus strategy. We'll talk about it. Let's read this part. Porter argues that if a firm tries to combine different generic strategies, meaning you want to be somewhere of a cost leader also, and then somewhere you want to be a differentiator also, then it risks losing its competitive advantage. So either you could get a competitive advantage by being a cost leader, or you could get a competitive advantage by being a differentiator, but not by combining both of them. In that case, you will be at a risk of being stuck in the middle. Okay, there is a idiom when they say na hi ghar ka na hi ghat ka. So what is happening? You are neither a cost leader, you are not a differentiator. You are just stuck in the middle. So Porter said that the firm should avoid doing this to ensure that they continue to run in the long run. Okay. So cost leadership and differentiation are industry-wide strategies. However, a firm could also, so that came with time. Porter initially suggested two strategies. However, a firm could also adopt a focus strategy, restricting its activities to a segment of the market and pursuing a strategy of cost leadership or differentiation within its chosen market niche. Are you able to understand what it is saying? So it is going to cater to only a segment of the overall market. It's not going to cater to the whole market. It will carve out a market within the bigger market, and then it will follow either cost leadership or differentiation. Think of something here. Which company could be following this? They carved out a niche in the market, and then they are either following cost leadership or following a differentiation policy. Think. Which company could be doing it? Tanya says Oppo. Okay, I am thinking about premium clothing brands, or you can say premium handbag brands. What are they doing? Are they doing something like extraordinary? So if you think about Louis Vuitton as a brand, or yeah, Mercedes, you can take. So they have carved out a niche in the market that we are going to cater to only these high net worth people. Okay, this is my market. And I'm going to provide best in class features in this market segment. So there could be, companies like BMW, Mercedes, then what else? So different high luxury and car brands, but each one of them are differentiated from the other, right? So what are they doing? They have followed a focus strategy. They carved out a market within the bigger market, and then they're following either cost leadership or differentiation there. And then this is for a differentiation policy example, BMW, Mercedes, you can take, or Louis Vuitton, or the big luxury brands which are there in the market. Similarly, for a cost leadership focused strategy, we could think of this example which Tanya gave, Oppo. So Oppo is catering to the smaller segment. It doesn't cater to the high-end brands. You will hardly see a very highly priced Oppo phone, because there will not be takers for that phone at that price. Because people who want premium phones, they will either go with Apple, they will go with Samsung, or maybe OnePlus. Even OnePlus is not that highly priced like Samsung and Apple's. So Oppo has carved out a niche that they are going to cater to certain specific lower end requirement of the mobile phone market. And then they are following cost leadership there. So there were other brands like MI, Oppo, Lava, Carbon. So all of these brands are there. And then Oppo is leading it because of the cost leadership. They are providing very cheap phones. And the features are also good. So they have followed cost leadership in a focus strategy. Are you able to understand? So the two main strategies are cost leadership and differentiation. Then with time, it was found that companies, they also create a smaller segment within the bigger market and then follow either cost leadership or differentiation. Have you understood this? And you will add this one strategy in your tab in that summary note, okay? Where you're preparing the summary for all the models now, this is another model. Call it Porter's generic strategy, and you can write cost leadership, differentiation, and then focus strategy. And focus, you can write, it has both cost leadership as well as differentiation. Is it fine, everyone? Are you able to follow me? And the examples, can you follow that? Okay, great. Then let's see what are the implications of these strategies in performance management. I shortlisted a video on cost leadership. I will play that for you. Let me know if you can't hear or see. I'll be playing the video. Are you getting audio? No, no, even I'm not able to hear. Wait, something's wrong. Why am I not able to hear? Oh. Yeah. Check now.
The first competitive strategy we'll examine is cost leadership. It's straightforward, isn't it? You have to be able to produce products or provide services that are cheaper than the ones
You're able to hear it now, right? Okay.
The first competitive strategy we'll examine is cost leadership. It's straightforward, isn't it? You have to be able to produce products or provide services that are cheaper than the ones offered by competitor companies. If a company adopts this strategy and sustains costs lower than its peers, then it will succeed. Typically, cost leaders will sell at prices lower than their competitors. This way, they will win price-sensitive customers, the ones looking for a bargain, and given that price-sensitive customers are the absolute majority, cost leader firms can win a sizable market share and sell a lot of units of the goods they're selling. However, the drawback is that the low prices of these products mean lower margins for the firm. A margin is formed by the revenue obtained from the sale of a product minus the cost sustained to produce the product. So, a cost leadership strategy means more units sold and a lower margin per unit. Selling at prices lower than competitors is a valid idea. However, companies must find a way to do that. If you want to sell at a lower price, then you have to do something differently than your peers. There are several ways to establish a competitive advantage related to lower costs, and they all have something to do with the concept of efficiency. A cost leader must be efficient. Let's see how companies can do that. One of the fundamental ways to push down unitary costs is to leverage economies of scale. The more units of a product are sold, the lower is its unitary cost, the cost of one unit. How come? Well, there are several costs which are sustained only once. These are the so-called fixed costs. There is an inverse relationship between the quantity of output and unitary costs, meaning the higher the output level, the lower the fixed cost per unit. The reason is that fixed costs are spread over a large number of products and services. Economies of scale are the main reason for the predominance of large corporations in most industries. Let's provide an example with the airline industry, where the cost for development of a new aircraft is huge. Boeing 747 is one of the most successful aircraft projects because the company built 1,415 aircrafts. Concorde turned out to be unprofitable. Only 20 planes were built. However, the cost of research and development of the two projects is comparable, right? Both required engineering teams who worked for years to design the two planes. However, in the first case, the cost was spread among 1,415 sales, and in the second among 20 planes. This is a very important concept. The more units we produce, the lower the unitary cost we have sustained. Some companies excel at achieving economies of scope. If they operate in more than one business, certain firms can often achieve economies of scope, which pushes down their costs even lower. Economies of scope consist in a proportionate saving gained by producing two complementary products. The cost of producing the two goods under the same roof is lower than the cost of producing them separately. A good example for an economy of scope is P&G's acquisition of Gillette. Once placed under the same roof, the two companies could use the same distribution channels and lower their logistics and sales expenses. Another good example is the production of milk and cheese. It makes sense to produce both products under the same roof, as the materials required for their production can easily be combined, right? Another cost driver companies pay attention to is process design. We can obtain a cost reduction from a change in the way a process is being carried out, when less input is needed for each unit of output provided. A new process may reduce costs dramatically. The assembly time of Ford's Model T is a great example. Initially, it took 106 hours to assemble a Model T. Eventually, when the assembly line was improved and made much more efficient, the time was reduced to 6 hours. Remember, for a new process to lead to efficiency, it has to be combined with changes in a company's organizational structure, product design, management control systems, HR management, and so on. Success stories of companies such as Walmart, McDonald's, and Toyota, which match their process technologies with their structures, management systems, and product design, are proof this is true. For perspective, GM has been singled out as a company that implemented a new process technology without the management and organizational changes. GM did not become the world's most efficient car manufacturer, which was its primary goal. Moving on. Firms with lower input costs can have a significant cost advantage over their rivals. Lower input costs derive from lower wage rates, access to low-cost raw materials, or an ability to negotiate well with suppliers and to excel at procurement. In today's globalized economy, several companies have taken advantage of lower cost of personnel in developing countries. The outsourcing industry in these countries is flourishing, as call centers, customer support centers, finance and accounting divisions are being transferred to these lower wage countries. The result from these operations is a lower cost of personnel over the long term and a possible source of cost advantage. Cost leadership is a strategy pursued by several large companies. Walmart, IKEA, Amazon, McDonald's, Dell Computers, Zara, H&M, and Southwest Airlines are some established names you've heard, and they're all focusing on costs. So, for example, IKEA, the Swedish furniture retailer, sources its furniture from countries where the cost of personnel is cheap. In addition, the company offers a very basic service. It doesn't assemble or deliver the furniture it sells. McDonald's uses inexperienced staff instead of trained cooks. The company hires few managers and saves from cost of personnel. Southwest Airlines minimizes the time its planes spend at airports by organizing more flights and filling up its schedule. Acquiring a cost advantage is definitely one way to go. However, it's difficult in today's highly competitive markets. Companies that choose this path should focus on efficiency in all its forms and in a continuous redesign of their operating processes.
Let me ask you a private question.
So that was a very detailed video on cost leadership, how it is actually done using economies of scale, using economies of scope, process redesign, and lower input costs. Okay, so in a very detailed way, we understood that yes, cost leadership means providing our products at lower cost, but how is it achieved? We found that in that video with a lot of examples. Any doubt from the video? Did you understand the concept properly from there? What they were trying to say, all the examples like McDonald's, Amazon, then Zara, right? Very informative. Let's see what is given here. So in cost leadership, so what are the implications for performance management under cost leadership? So first of all, financial control is likely to be crucial. There may be an emphasis on variance analysis. So you would have studied variance analysis in somewhere or the other, maybe, like, right? Material price variance, then material usage variance, labor rate variance, labor efficiency variance. Heard about it ever? These variances? I mean, it's there in costing papers in CA and also in PM it is there, yes. Like, so these are the variance analysis which are done for costs. So if we are in cost leadership, obviously our focus will be on controlling the costs. How can we find out whether the costs are under our control or not? That whether the actual costs are lower than the standard costs. Okay, so that is why it is given for managing the performance in a cost leadership environment. Your focus will be on variance analysis and focus on maximizing efficiency and reducing waste. Okay, then next is production facilities are likely to be set up to obtain economies of scale. We saw those examples, right? And to mass produce goods wherever possible. Firms may try to exploit the Firms may try to exploit the learning curve effect. This is also a topic which is there in performance management paper, learning curve effect. So what does the learning curve effect say? That the more time you spend on doing a repetitive task, the less time per unit you will be consuming. Okay, so every time the production doubles, the time per unit comes down. Okay, on the factor of the learning curve. So maybe the learning curve effect is of 80%, that the time consumed will come down by 80%. So this learning curve effect is used in a cost leadership manner. Okay, firms may try to exploit the learning curve effect, but producing more items than its rivals, a firm can achieve lower average cost. May also consider Kaizen costing. Kaizen costing is also a part of the performance management paper, but we will also be covering it in chapter 11. Kaizen costing is nothing but it is the manner of costing which assumes that there is constant improvement. There is no stable stage in the work. You're constantly improving the efficiency, reducing the time taken. So this leads to cost leadership. There will be efficiency in the cost. So definitely the cost will come down. And then benchmarking. Benchmarking is nothing but that the industry works at a 20% gross profit margin. And we are at 15% gross profit margin. So we are lower the industry margin. So we need to work on reducing your costs such that the gross profit margin can come up. Okay. So these are the things which will be used for performance management in a cost leadership environment. Are we clear? So what did we study? Variance analysis can be done. Then we can see learning curve. What is the learning curve effect? And then what is the impact of Kaizen costing? Okay, or benchmarking. Where are we as compared to the industry benchmark? Okay. Then what are the implications for performance management in a differentiation strategy? Let's see. Although a firm pursuing a differentiation strategy will still need to monitor its costs, it will also be very important for the firm to measure its performance in those areas which differentiate its products or service. So obviously a firm which is following a differentiation strategy will also be focused on reducing costs, but its primary focus will be on those products, on those features which is actually differentiating it from its competitors. Okay, like what? Product features. Maybe your phone has a certain feature which other phones don't have, which other brands' phones don't have. Okay, product quality, brand image, quality of service, speed of delivery. So you can say that Amazon, Flipkart, they're following such speedy, they're giving such speedy delivery. So it becomes so difficult for new entrants in the industry to actually live up to that speed. So that is there in companies which are following the differentiation strategy. They are focused on cost, but they are primarily focused on those features which actually differentiate them from the competitors. These characteristics are often non-financial, which means that firms will need non-financial performance measures linked to these characteristics. So here you've seen that it's mostly financial factors which you're considering. But in case of a differentiation strategy, the way to know whether or not you are differentiating from the competitor characteristics are mostly going to be non-financial in nature. Pursuing a differentiation strategy needs to select performance indicators, which underpin the areas of performance which differentiate it from the competitors. So the focus of performance management or performance measurement here will be on those features which differentiate them from the competitors. Okay. And she says, so company needs to innovate its products on regular basis to differentiate itself. Yes. Or ensure that its technology doesn't get leaked out in the market. So you would have seen Domino's cheese burst pizza, right? You all would have eaten. It is a different. A lot of the pizza companies have copied that style, but are they up to that mark? At least not for me. I really love cheese burst pizzas of Domino's only. So it's a differentiation strategy. They have been able to preserve that secret. Okay. Continue to ensure that yes, we are doing something new. In fact, I think it was which one? Pizza Hut, na? Pizza Hut came out with pasta pizza or something, and then Momo pizza. So they keep on doing these things to keep themselves, relevant in the market and innovation. Some things work, some things don't click. So it's all right. You just have to keep on experimenting. They check these things. How much are they, innovative? And then we also have one more model. It's there in the syllabus, balanced scorecard, which also measures how much the company is innovating. Okay, we talk more about innovation there. But yes, in differentiation, they have to see what their performance is as compared to the competitors, whether they are still maintaining that differentiation feature or they have to do something new to get a newer differentiation feature. Okay, then it's the next topic only. I believe all of you are adding new tabs in your summary notes. Please let me know, confirm to me, are you adding new tabs? This is the newest model you have to add there, balanced scorecard. Please follow it. You might not realize the importance of what I'm saying right now, but by the time when the syllabus is over, you will feel that, ma'am, we are lost in the number of models we have to study. That's why I told you in the first self, start making a summary note whereby you will just keep on adding one tab for all the relevant models. So it will become a quick reference point before your exams. Okay. Aishi says, yes, others, I hope you all will prepare this file which I'm talking about. Okay, great. Shalya says, in order to adopt differentiation, we have to spend on and on in market research. I'll not say on and on. I say if you take Domino's cheeseburger pizza, for example, yeah, R&D, I understood what you're saying, R&D. What is it? It is differentiating. So if you're talking about BMW cars, Mercedes cars, how much they're able to retain it to themselves? Are there companies who are copying their features? Are they still the differentiator? It all depends from company to company. Yes, there will be a significant expenditure on R&D and maybe on preserving the current features or on developing new features. Yes, we can say in a way that yes, on and on, there will be R&D expenditures in companies to ensure that they remain the differentiator. Okay, that's right. Moving on, the next topic is balanced scorecard. Again, very important. See, I know there are a lot of theory topics which are coming, but in exam now, they will be together with some practical bit. They will give you some data, then you have to analyze. Like this example which you saw now on BCG metrics. What did it do? I just taught you the theoretical model, but the question was clubbing both practical and theory. So similar approach will be there in exam questions also. You need to know the theory to be able to answer the practical questions also. So please stay focused. And if you do not listen and you think that you'll just read, I'm telling you honestly from my experience, it becomes very, very difficult to read through a theory topic like going on. So if you have heard properly and you're able to retain those concepts, just by practicing questions, you will keep on getting the revised. You will keep on revising these concepts. So be very attentive in the classes. Shalya says identification is important for differentiation. Yes. Identification of the feature which is differentiating you from the others is very, very important. Identification and then maintenance of that feature. Okay. Let's start this topic, balanced scorecard. Key features. So there's a balanced scorecard that there are 4 quadrants in a balanced scorecard. Like we studied for BCG metrics now. Similarly, there are 4 quadrants in a balanced scorecard. Let me show it to you first. Where is the diagram? Not seeing the diagram. Just give me a moment. I'll fetch it. Those of you who are coming from PM paper, I believe this class must be sounding to you like a recap class, na? All the topics. Just fetching the balance scorecard. First, let me show you some video also here, and then we'll skip to the diagram. Let me present.
The Balance Scorecard.
Have a look at the video first, and then I will show you the diagram. Yes, definitely, Shavya. Approach is very different in performance management and advanced performance management. As I said, the concepts would be similar. The way you have to apply it is definitely different. Agreed. So have a look. For those of you who are hearing about Balance Scorecard for the first time, this video will be helpful.
The Balance Scorecard. Measuring a company's performance is important. If something doesn't get measured and reported, then probably nobody in the company will be paying much attention to it. Traditionally, companies have relied on financial indicators in order to measure their performance. This worked well when most of a company's assets were physical and could be reflected in a company balance sheet, such as machines, buildings, and cash. However, these days, a company's success no longer depends primarily on its physical assets, but more on the less tangible factors such as the loyalty of its customers, the efficiency of its work processes, or the skills of its employees. These important topics don't show up anywhere on the company's financial statements, so we cannot track their progress by just looking at financial performance indicators. That is why Professor Robert Kaplan of Harvard Business School and management consultant David Norton developed the Balance Scorecard. They argued that, just as a pilot relies on more than one measure in order to fly a plane, managers need a broad set of performance indicators to lead a company towards success. In the Balance Scorecard, the company vision and strategy are at the center and are surrounded by measures along 4 perspectives: financial, customer, internal business process, and learning and growth. Let's have a look and see how the Balance Scorecard works. First, we draw the 4 dimensions. In the center, we write the vision or mission of the company. Say you run a coffee shop company and your goal is to become the best coffee shop in your city by serving delicious coffee and providing excellent service. Then we can start defining measures for each of the 4 dimensions. The financial measures reflect what the company's shareholders ultimately care about, including things like sales, gross margin, and net profit. However, your coffee shop can only have financial success if it has lots of happy and loyal customers. So in the customer dimension, you can measure how many customers you serve each month and how satisfied they are with your coffee. In order to do well along the customer dimension, a company must do its work well. This is measured by the business process perspective and deals with the question, what must we be good at in order to succeed as a business? Performance indicators here can include the time taking to process an order, time needed to prepare a coffee, and the number of complaints or quality incidents. Finally, a company needs to keep on learning and improving. The question, can we continue to improve and create value, is with measures that can include the skills acquired by company employees or the development of new items on the menu. In the end, all measures are related to each other. Only qualified baristas will make good coffee and serve customers well. And only with good coffee and excellent service do customers come to your coffee shop, which in turn will lead to good financial results. So, to perform well financially in the future, companies need to do well on the customer, business process, and learning and growth dimensions today. This is why financial results are referred to as lagging indicators, since they tell us about past. Results related to the non-financial dimensions are called leading indicators. They give us information about future performance and need to be managed today in order to get good financial results tomorrow. The Balance Scorecard can serve as a performance management system for the entire company. As an example, for the customer dimension of the Balance Scorecard, say your coffee shop wants to maximize the number of customers and the level of customer satisfaction. It can then set specific targets for each of these goals and define a range of actions in order to reach these goals. Once this is done, the company can use the scorecard to track progress and take actions that may be needed. In this way, all the actions of a company are aligned with each other and contribute towards reaching its overall goal. That concludes the balanced scorecard.
So that was an introductory video on the balanced scorecard. As you saw that there are 4 quadrants in which you check whether you are measuring the performance there properly or not, right? So this was it. Financial perspective, then internal business perspective, innovation and learning perspective, and customer perspective. So I've included this graph in your deck also. Basically, financial perspective is how do we create value for our shareholders? Okay. Internal business is what must we excel at? Innovation is, like we were discussing, innovation, should the company keep on innovating? Yes. How much it is innovating, it gets measured here. Can we continue to improve and create value? And customer perspective is how loyal our customers are. How do customers see us? That is about the customer perspective. So there are 4 perspectives in a balanced scorecard approach. There's one more video which I would want to show you. The one I've played, and there's one more. Let me present that. It's from the Harvard Business Review. Let me present my screen. The short one.
Introducing new products, and again developed operational measures for each goal. Last, for its learning and growth goals, it decided to focus on developing new products rather than improving existing ones. The semiconductor company found that learning and innovation led to better competencies and processes, which in turn boosted customer satisfaction and ultimately generated better shareholder returns. In other words, they learned that the order of the balanced scorecard matters. When used correctly, it reveals the real drivers of long-term success.
Right? So you saw that how a company can focus on the long term by using a balanced scorecard approach. Okay. So if you're just following the financial perspective, then you will be focused on the short run. But if you follow a balanced scorecard approach, with all the internal business perspective, the learning and innovation, customer perspective, and the financial perspective, you are focused on the long-term vision of the company. Okay. So what is the feature? I mean, what are the constituents of a balanced scorecard? What is the goal under each perspective? See, that is what the diagram also said. See, what are the goals under each perspective, and what are the measures? How are we going to measure it, whether we are actually achieving our goal or not? Okay, so that is goals and measures for each perspective. Remember, these perspectives very, very important. Included in your summary notes. This diagram you can put there. So financial perspective, internal business, innovation, learning, and customer perspective. And for each one of them, what is the goal that the company has in mind, and how are they going to measure their progress towards these goals? So key features of the scorecard to note in terms of performance management process is, number 1, it links strategic elements, example, mission and objectives, to operational elements like targets, key performance indicators. So what are they doing? Goals, metrics for each one of these perspectives. So it is linking the strategic elements with operational elements, so that actually the strategies are implemented at the lower levels. It highlights the need to consider performance from a range of perspectives, example, customers and business process, and not just financial. The balance between non-financial measures and financial measures in the scorecard is very important. That is why it is known as a balanced scorecard, that all the perspectives are balanced and it ensures the long-term growth of the company. Is it clear? Any doubts from this topic, balanced scorecard? Have you been able to understand what each of these perspectives denote? And I believe the 2 videos with all the examples, they were really helpful. Any doubts do you have here? Is it fine? Shalda says yes. Sanya says yes. Okay, great. Okay, so let's see what are the features of this balanced scorecard. Traditional measures are mainly inward-looking and narrow in focus, with overemphasis on financial measures and short-term goals. Now, you would be realizing that also, like normally, traditionally, what are we focused on? How much profit are we making, right? But in modern view, we are also seeing how the customers are satisfied, how our processes actually are. Are they efficient? Are we generating sufficient value for our shareholders? How much are we innovating? Because innovation is what is left behind after your company is gone, right? So innovation is something you are giving to the environment, to the society as a whole. So this is something which is getting measured in the balanced scorecard. Traditionally, it was not getting measured. The balanced scorecard focuses on both internal and external factors and links performance measures to key elements of a company's strategy. It requires a balanced consideration of both financial and non-financial. So internal as well as external, financial as well as non-financial, both of them get measured in a balanced scorecard. It attempts to identify the needs and concerns of customers, right? Because you are focused, you are keeping their perspective as a goal, and then you're measuring how are you performing towards that goal, right? So it ensures that the needs and concerns of the customers are met. This information can then be used to identify new products and markets. Comparison with competitors can be made in order to establish the best practice. Understood? So this was the balanced scorecard. For those of you who are hearing about it for the first time, I believe the concept is clear, and those who have studied it in performance management, I'm sure it's a very good recap of what the model really is. Okay. Okay. So these were all the models which we have discussed so far. Now the next topic in this paper, in this chapter, is changing role of management accountant. Now the role of the management accountant has changed over time. The requirements, which is something which is expected out of a management accountant, that has changed. So if you are working as a consultant in a company, what is expected of you now? Let's see. The modern view, management accountancy is now often seen as a key driver of improved strategic performance, not just as a mechanism for imposing short-term control. So you're not just focused in the short term, but you're focused in the long term. In other words, there has been a shift from performance measurement to performance management. You're just not measuring it. You are actually managing the performance and ensuring that the success of the organization is there. That is acting as internal business consultants. It is not just a normal accountant who is just calculating and who is measuring things. You're actually suggesting things for the long-term growth of the company. Growing numbers of management accountants spend the majority of their time as internal consultants or business analysts. They spend less time preparing standardized reports because that is all automated now. You don't have to actually manually sit down and prepare the format and then publish your reports. It's not like that. If you automate your reports, it's just a matter of a few minutes that the report will get generated. Now it's on you how you analyze the data from that report. But more time analyzing and interpreting information. Many no longer work in an accounting department, but are based in operating departments with which they work, meaning they are increasingly involved with operations of the business and more actively involved in decision making. See, once you qualify as professionals now, your focus automatically is changed. Like, unlike you are like a normal graduate, someone who is there in a company, versus when you are qualified as a professional, your roles change substantially because they know now that your education and your focus has always been on decision making, and ACCA all the more focuses on decision making. You would realize that when you're studying for the professional papers, strategic professional papers, each one of these papers, they're not asking you to rote learn anything. They know you can find these stuff on Google. And that is the reason they give you all types of formula sheets. Hardly the difficult formulas they will give you for learning. They will give it to you in a formula sheet in exam. They don't expect you to rote learn. In fact, in the advanced financial management paper, there is a Black-Scholes model. When we gave the exams, it's very difficult to remember the formula of Black-Scholes model. There are a lot of, numerator, denominator, and the calculation is very difficult. But in AFM paper, they give you a BSOP calculator separately as a response option, so that you don't even have to see where to put the brackets. You just input the variables and then you get the result. Because in reality also you do that only. Do you actually write down the Black-Scholes model in an Excel sheet? No. You will follow any Google calculator and then get the results and use those results in your interpretation. That is what ACCA also does. It is asking you to make decisions rather than just doing calculative stuff. That is reflecting the change which is happening in the industry. You're not just mere accountants. You are someone who is at the senior level making important decisions for the company. Okay, that is the modern view. Then the next concept which you need to know in ACCA, and it's there across SBL also, it's there partially in the AFM paper and PM paper also, integrated reporting. Okay, so integrated reporting, I'm sure those of you who are coming from CA background will not know much about it. So please be very attentive here. It's an important topic which is a part of a lot of subjects. So integrated report, it's a concise communication about how an organization's performance management. So in this entire subject now, you will see that the focus is not just on presenting financial information to the shareholders. Their focus is to ensure that the shareholders and the other stakeholders of the company are equally apprised about the different aspects of a company, which are not financial. So integrated report is a medium to convey that information to the shareholders, okay, and the other stakeholders, of course. So integrated report is a concise communication. You can consider it as a report format which is communicating how an organization's performance management in its commercial, social, and environmental context leads to the creation and enhancement of value over the short, medium, and long term. How are they enhancing value over the short, medium, and long term? That is what integrated report is about. Integrated reporting aims to explain an organization's ability to create and sustain value. In doing so, it also highlights the importance of long-term business sustainability within an organization. Okay, so normally integrated reporting questions, you don't have to actually prepare the report. You will have to give the elements of what the company can follow in their reporting. That this should be a part of their integrated report. Okay, integrated reporting should help stakeholders make a meaningful assessment of the long-term viability. So always here the focus is on the long-term viability of an organization's business model and its strategy. It is a practical application of strategic management accounting and links to many of the themes in the APM syllabus, and not just APM, I'm telling, it's there in a lot of other syllabus as well. Rather than focusing on narrow financial performance objectives, integrated report should encourage management to focus on creating a sustaining value over the long term. This is the ethos of strategic management accounting. Ethos meaning the practical application of strategic management accounting, right? You are focused on the long term. Okay, so that is integrated reporting is a medium to convey that information to the stakeholders. This sheet, you can add it in your summary notes. Integrated reporting, add these 6 capitals. So if there is a question on integrated reporting, you will have to classify the question scenario within these 6 capitals. And for that, you need to remember what these 6 capitals are. It will not be given to you. Okay. So what are the 6 capitals? Financial, manufactured, human, intellectual, natural, and social. Okay, so the International IR Council in our International Integrated Reporting Framework encourages organizations to report on 6 categories of capital. So financial is there, and then there are other factors also on which the organization is expected to report. Okay, so first one is financial. Let's see what is there. Characteristic element of the category of capital. So it is a brief explanation. See, when you are going to be reporting the financial capital, what will you report? You will report on funds available, obtained through financing. Basically, whether you have obtained it through equity finance, whether you have obtained it through debt finance, or whether it is generated internally, right? Like retained earnings. So you will, in financial capital, you are going to talk about these things in your report. Please listen to this very carefully. The concepts are very easy. It's just that how the question will be asked and what are you expected to write. That is what's being covered here. It's not just about rote learning these 6 capitals, but what is going to be the constituent of each capital in the report that you need to know. So financial is very simple. What are the funds available and the sources of finance? Okay. Then next is manufactured capital. Manufactured physical objects used in production or service provision, including building, equipment, and infrastructure. So manufactured capital is something you can say, you know, the tangible capital of the company, tangible assets, which you call, right? So your report about the manufactured capital, non-CA meaning non-current assets. Yes, which are used in the production or service provision. Manufactured physical objects. Okay. Then next is human capital. So first one is financial. You're reporting about the finances. Manufactured capital is manufactured physical objects like building, equipment, and the other infrastructure. Then third is human capital. Human capital is, you can, you know, it's very easy to assume it is talking about the employees of the company. So alignment and support for an organization's governance framework and ethical values. So every organization, it has a vision statement, a mission statement, ethical values, which it is going to live by. Are they aligned with the employees of the company? Okay. Ability to understand and implement organizations' strategies. Loyalty and motivation for improvement and innovation. Are your employees motivated to improve their performance for the company's benefits? Okay, so that is the human capital. Then fourth one is intellectual capital. This one is your intangible assets. Intangible assets providing competitive advantage like patents, brands, etc. Then next is natural. Natural is areas where an organization's activities have an impact on the natural environment, including water, land, minerals, and forests. So in performance management paper and APM, there is a lot of focus on environmental management accounting, right? It's there in this curriculum also, you'll come across it. So in environmental management accounting, the focus on how much the company is focused on conserving the environment. So natural capital, when you will be reporting in your integrated report now, you will talk about how organizations' activities are actually protecting the environment, if they are, or how they are harming the environment. Okay. Yes, absolutely right, Amit. It's like the carbon footprint of the company, or how much the company is, you know, like you would have seen Mintra for Earth program that was run by Mintra. It used to display that symbol across some brands, that this brand is using recycled products in their manufacturing of clothes. So this is a focus of natural capital when you're reporting, when you're doing integrated reporting. The next is social. Social is how you are managing your key stakeholders. Like we discussed, what are the key stakeholders of a company? Shareholders, customers, suppliers, employees. How much the company is actually working on preserving its relationships with the key stakeholders. So key stakeholder relationships, willingness to engage with the stakeholders. So these are the 6 capitals. simple. The concepts are simple, nothing much to explain here. Financial, manufactured, but thing is, from exam perspective, you need to. So I was saying we were repeating the 6 capitals. What are they? Let's quickly do it. Financial, manufactured, human, intellectual, natural, and social. Try to remember it. FMH, INS. What are they? Financial, manufactured, human, intellectual, natural, and social. And what they represent, that's easy to remember. Financial is sources of finance. Manufactured is you can talk about the non-current assets, manufactured physical objects which are being used. Then human is how motivated your employees are, how loyal they are, whether they are able to implement and apply the organization strategy in their work. Then intellectual, the intangible assets of the company. The natural means what is the relationship the company holds with the environment, how environmentally conscious it is. And then social is about your key stakeholder relationships, how much you engage with your stakeholders. Okay. So is this fine? All the 6 capitals, are you able to understand? Any doubts here? All clear. Great. Then the last slide of this chapter, impact of integrated reporting on information requirements. See, the primary focus of integrated reporting is to record the non-financial factors, not just the financial factors. Like in balance scorecard, we were also focusing on non-financial factors. Here also we are focusing on the non-financial factors. Integrated reports describe an organization's performance in relation to the 6 different capitals, in contrast to traditional annual reporting, which focuses primarily on financial performance. This means an organization needs information about its performance in relation to each of the different capitals. So you will have to report what is your performance for financial, manufactured, and all of them. So which means that organizations will need to record non-financial performance in a way which provides it with suitable information to include in the integrated report. See, one of the videos which I played for you, what did it say? If something is not getting measured, it will not, if something is not getting reported, it will not get measured. Remember this line, very, very important. If you are not going to report the non-financial factors anywhere, if you're just following the traditional reporting requirements, you will not even care to measure the non-financial factors, right? Something which is not reported does not get measured. As simple as that. So integrated reporting, since you have to report on these 6 factors, you will record the necessary indicators to measure the performance of each of these capitals. One benefit of integrated reporting is that it helps organizations to make clearer links between financial and non-financial performance. By focusing on value generation in its broader sense, integrated reporting will also encourage organizations to review the set of performance measures they use. Are their performance measures adequate? Are they capturing the non-financial indicators properly or not? One of the main consequences of integrated reporting is likely to be the increased use of non-financial data to gain a clearer picture of an organization and its performance. So in performance management, there was one chapter which focused on the non-financial indicators. So it talked about how will you actually make use of these data. What factors can you calculate? So you can calculate the customer satisfaction using surveys. You can be asked to rate the satisfaction of your customers on a scale of 1 to 5. You would have got such feedback calls, right? So these are the ways to capture the non-financial information, and that can be implemented at the organization only if they are reporting it. So different ways can be followed, not the part of the current curriculum, but we studied it in the PM paper, that there are different ways to capture the non-financial information. That how many orders are you delivering on a daily basis, how much of it is timely. Then there's one example which I gave you Okay, customer rating. Ma'am, what's the difference between balanced scorecard and integrated reporting? Tanya, the objective is same. The objective of both balanced scorecard and integrated reporting is same, to ensure that the organization is focused not only on the financial perspective, but also on other non-financial perspective. It's just that in the balanced scorecard, the focus is on goals of each perspective and the measures along with them. Okay, so it's made in that tabular format only, goals and what are the measures for it. In integrated reporting, again, obviously nomenclature is different for the different capitals which we are measuring there. It was internal business, customer, learning and innovation. See, you did not see these same names here. Nomenclature is different. Most of them are common also, like this intellectual, you can call it similar as learning and innovation. Then customer focused, you can say it's not here. The way in which you're reporting, there you're reporting the goals and the measures. And here you are reporting on it's just general. There's no predetermined format that you have to follow. It just suggests that you can report on the integrated report. Okay, the focus of both of them is same, to ensure that the organization is giving due importance to the non-financial information as well. For balanced scorecard now, remember this part, goals and measures. This is how it is reported. Okay, and see, this is something, let me tell you one more thing. This is more from the management perspective. Prepared from management perspective only, for senior management, that this is how we are pairing in a balanced scorecard. But integrated reporting now, like you publish your annual accounts, integrated reporting is also published. Whichever company wants to adopt it, it's not there in India. So whichever company wants to adopt it, they can adopt this integrated report and publish it to the key stakeholders. Okay, just give me a moment. I think I will search up an integrated report of a company. Can you moment? Try to search for it. I'm not sure if I'll get or not. I'm not getting the integrated report of any one company. Just looking for it. Give me some time. It's not there, can't find. Anyway, so yes, what I was saying is that balanced scorecard is more from internal perspective, and the integrated reporting is done for the external stakeholders of a company. Okay. In fact, we have understood And that's all in this chapter, which we have gone through. What did we study? We studied a lot of models here, starting from SWOT analysis, then this hierarchy, Robert Anthony's hierarchy of strategic tactical control, and then what are the issues which are there, and of course the performance management implication for each one of these models we have gone through. SWOT analysis, PCG metrics, then what Porter's generic strategies, cost leadership differentiation, and focus strategy. And then finally balanced scorecard and integrated reporting, and what is the modern view of an accountant. Okay, can I wrap up this chapter? Any doubts? Any doubt? Can I wrap it up? We'll start off the next chapter, chapter number 2. Okay, so the second chapter in the curriculum is performance hierarchy. Very interesting, nothing complicated. Again, it's just theoretical, so please stay tuned. So the first topic is mission and mission statements. You all would have seen the mission or vision statements of companies, have you? Let me show you some examples here. I'll open up. It's published for the stakeholders. Yeah, let me show this to you for ITC. See, it's on ITC's website only. You can find it for any company. They always publish it on their website. What is the vision and mission? Wow, the photo is not loading. What do I do? Let's see it for any other company. I think there is some problem on the website. They're not displaying it. It's an image embedded on the website, but it's not opening. The values are showing. Which company do you want to look at? Tata Steel. TCS, let's watch. See. Our core values and purpose. They call it by different names. The idea is to provide people an insight on what they believe in, what their mission is. Why are they there? Why is Tata Group here? So it's our core values. Every business is born out of the belief that you can make an impact, that you have an idea that matters. At TCS, we go beyond helping business transform through technology. This is their mission. We go beyond helping the business. We help them make a meaningful difference, translating their aspiration into reality, building on a customer's ambition and optimism to transform their business for the better, so that their contribution is in turn felt by their customers and the communities they serve. So basically, they're helping the customers to achieve their ambition. At TCS, we instill hope into the business and trust into the enterprise. This was for TCS. Let's see. Any other company you want to look for? Let's look it up for which one. Just minute. Apple. I'm not sure. Let's see. Apple, Meta. Let's see. I doubt. It's an American company. Indian companies, they do publish. It's there. See, let's see. It's not on Apple's website. Someone has compiled it. In India, the companies, they do publish their mission and vision statements mandatorily required. Apple's vision statement is, we believe that we are on the face of the earth to make great products, and that's not changing. So that's their vision. Core values. Have I missed out on the mission? Amit wants to see for Royal Enfield. Where is the mission? I can't see the mission. Starting with vision and then core values. These are the core values. Accessibility, education, environment, inclusion and diversity. Slogan. What's Apple's slogan? Think different. Yes. Apple's slogan. Think different. Headquarters. They have mentioned. I was looking at something at the company's website. That's what I was looking for. It's not there. Let's see for Meta if it is there. Oh yes, it is there. Let's see. What are they call it different names. The objective is same. Our mission, giving people the power to build community and bring the world closer together. And they are doing it through the different apps, Facebook, Insta, WhatsApp. They are bringing the people together, right? They are bringing the world closer together. So that's the mission they are living with. Our products empower more than 3 billion people around the world to share ideas and offer support. These are current openings. So yes, this is about their mission. So coming back to the slides. So as you saw, that each company, they publish their mission and vision to the public, to their users. So the people know what the company is there for. Okay. So mission and organization's mission describes the organization's basic purpose. Why is a company there? Okay. It has been argued that in order to be effective, corporate mission must contain 4 elements. And what are they? Purpose. So why and for whom the company exists. So Facebook, like Meta, we can say it exists for people who want to network. Why is it there? It is bringing the world closer together. And for whom the company exists, those who want to network. Strategy. The mission statement should mention the strategy of a company, the range of businesses in which the firm seeks to compete, and some indication of how it intends to compete. So what is the strategy it is following to compete with its peers in the industry? And the range of businesses in which the firm seeks to compete. Which all businesses it will be targeting. So that should be a part of the mission statement. Normally, it's suggested, not mandatory for companies to include these bits in their mission statement. And then we have values, beliefs, and moral principles which lie behind the firm's culture. And what are the values? So you saw, right? Most of the companies, they were giving their values: inclusion and diversity, employment. All of these are the values which a company lives by. So how are they contributing to the society? You can see that from their values. And finally, we have policies and behavior standards, guidelines which help staff decide what to do on a day-to-day basis to carry out the strategy. Okay, so like in Flipkart, we have ABC as a strategy which all of our employees we follow. Like what is that ABC? Audacity, bias for action, and having a competing attitude. That how are you striving for that, being a leader in the market? So all of these companies now, they follow these standards for the employees. It helps the staff to decide whether what they are doing is right or not. Okay, and it should be imbibed in the mission statement of a company. So this is recommendatory. Now please remember, how is it relevant for exam? Not some story reading we are doing. How is it relevant for exam? If the question is mentioning about the mission statement, they will give that this is the mission statement of the company. Then you can give the inputs, you can give the arguments that the mission statement is containing this much. It could contain these extra things, right? As per the, you don't have to mention the names, but when you mention, right, it should contain the purpose, the strategy, values, and behavior standards. It becomes a very, very properly drafted answer. It's not something vague you're writing, it's a part of the curriculum which you are including in your answer. So if there is a question on mission statement, you can write about the constituents which make a mission statement more effective. Okay, so mission statements, organization often set out the missions in a mission statement. It aims to provide employees and stakeholders with clarity about what the organization is fundamentally there to do. So what is the reason for the existence of a particular company? Most mission statements will address some of the following aspects, similar to what we just covered, right? What is the reasons for its existence? The identity of the stakeholder groups for whom the organization exists, right? Like, who is it existing for? People who want to network, then the customers, who all are going to be the customers of that company, and the commitment it makes to these groups. So you will see one of the sections of the company's website now are values, are ethics. They all put that on their websites so that the different stakeholders, they understand that yes, the company is ethical in nature. Then the next one is the nature of the firm's business, such as the products it makes or the services it provides, the market it produces for, or the business area in which it will operate. What is the firm's business? If it is like for ITC, it would say that it is in the tobacco, FMCG, and the hotel industry. So the nature of the firm's business is also a part of the mission statement of a company. Their photo didn't load up. ITC's mission statement would have been a very good example. Just try to search it again. It is loading. Yeah, it opened up now. Have a look here. The same page we were looking at now. Vision and mission. See, ITC's mission to enhance the wealth generating capability of the enterprise in a globalizing environment, delivering superior and sustainable stakeholder values. See, it is addressing that yes, it will deliver value for its stakeholders, be it anyone like shareholders, customers. Its focus, it is its mission to deliver sustainable value for its stakeholders, delivering superior products in a globalizing environment. So that is ITC's mission. Then what is the vision of ITC? Sustain ITC's position as one of India's most valuable corporations through world-class performance, creating growing value for the Indian economy and the company's stakeholders. And what are the core values? Trusteeship, customer focus, respect for people, excellence, innovation, and nation orientation. Okay, then they have given their corporate strategies. So you can go through these things. It will give you so much insight. Benchmark the health of each business comprehensively across the criteria of market standing, profitability, and internal vitality. Ensure that each of its businesses is world-class and internationally competitive. So these are the strategies which the companies are following. You can see that. Okay. create distributed leadership within the organization by nurturing talented and focused top management teams for each of the businesses. What does it show? It's employee focus. Okay. And then focus on the corporate governance program. So these are the things which are normally a part of the mission statement. This overall like values and everything, they're comprehensively together denoting the mission and vision of the company. So it aims to provide employees and stakeholders with clarity about what the organization is fundamentally there to do. That is the purpose of the mission statement. Right? We have gone through reasons for existence, the identity, the nature of the firm's business, and ways of competing. See, you were seeing the competitive strategies which the company is following, given on the ITC's website. Ways of competing, example, quality, innovation. They want to be world class. For example, quality, innovation, low prices, geographical spread of its operations. Nation orientation was one of these strategies, right? They mentioned. So they want to be available nationally and then also internationally. And principles of business, example, on non-discrimination or environmental issues. So like we were seeing the inclusion and diversity. What does inclusion and diversity mean? That you will give equal importance to people coming from different backgrounds, race, ethnicity, gender. So this is the way you are inclusive in your policy. Inclusion and diversity means what? You have people from all types of backgrounds, not just from a particular race or something. Okay. So mission statements, they ensure that the people know that yes, we are following proper inclusion and diversity principles in our company. We are following good principles and overall. So the general introduction, it can differ from company to company. Now, what are the advantages and disadvantages of mission statements? Let's go through this. What are the advantages? Communicate the nature of the organization to the stakeholders. By going to the mission statement, you understand that yes, these are the characteristics of this organization, the nature. Then communicate the desired culture and behavior, whether it is customer focused, employee focused, you get to know about it from their mission statements. Then provides an underlying framework for strategic planning. Ensure plans and activities are consistent with mission, developing performance measures. So once you have published your strategies to the public, right? Like ITC has published corporate strategies on its platform, on its website. So whatever internal policies which are being made, it will focus on ensuring that these objectives are achieved. Okay, so provide an underlying framework for strategic planning. Ensure plans and activities are consistent with mission, developing performance measures. Provide a focus for developing performance measures. Ensure performance measures are linked to the organization's purpose. Obviously, you have a particular goal. How will you know your progress towards the goal? By having proper performance measures. So you lay focus on developing effective performance measures. Like we discussed yesterday, right? For an example of a good performance measure and a bad performance measure. We were talking about how many hours I studied versus, and then when I said the complexity of the topic I studied in those many hours. So it's an improved performance measure. So there should be a focus on developing good performance measures on the basis of the objectives laid down in the mission statement. Okay. So these are the advantages of mission statements. Then next is the limitations or the criticism or the disadvantage of mission statement. What are they? They are full of generalization. And honestly, I felt this, or I don't know if you felt it or not. Did you feel this when you read ITC's mission statement? Was it not full of generalization? Have a look at it again. We want to be doing this, world class, this and that. See, to enhance the wealth generating capability of the enterprise in a globalizing environment, delivering superior and sustainable stakeholder value. Is it pinpointing at something, any of the businesses or anything in particular? It's just making vague general statements. Don't you agree? Yes. And you will find similar lines on the mission statements of a lot of companies. I was trying to look for more examples. I'm not able to get. But yes, these general statements are there in the mission statements of most of the companies. Okay. So coming back here. Yeah, even the vision is also like that. General only, nothing specific they're talking about. Generalize, we want to be world class and everything. Okay. Maybe, like, see, best, even the book has mentioned the example of using the word best, quality, even that quality word was there in the mission and vision statements of the company. Maybe public relations exercises rather than a true representation. So it's like a publicity stunt for the company that we are going to do. We are going to live by this mission and vision. Whereas in actual, they are doing something else. Obviously, the company is like even Satyam, which did a blunder, which did a major fraud. Even if you would have gone through the mission statement of that company, you would have felt, oh my God, there would never exist a company safe as Satyam. But you know the reality. So these mission statements, they are more like a PR activity, public relations activity, rather than a true representation of the culture or goals of the organization. Okay. See, if you remember it through examples, now you will clearly understand these points, not forget them. Then have little practical value if they lack detailed objectives and programs for implementation. If they're not detailed, general vague statements, you cannot actually prepare your objectives. So one of the points we were studying here was what? So if you have a certain mission to achieve, you will draw your objectives at each management hierarchy accordingly, right? But if your mission statement is vague, then obviously your objectives also will be vague, nothing special about them. So they have little practical value. And lastly, it may become obsolete if not updated for changes in the organization or its environment. And I'm telling you, ITC's mission statement would have been the same for a lot of years. No change in it. So they can become obsolete if they are not changed as per the changes which are happening in the organization. So these are the advantages and limitations of mission statements. I'm sure you'll be definitely remembering the criticism with all the examples we have covered. Advantages also very basic. Try to remember them. So they want to communicate to the stakeholders, the culture and behavior of the organization. They are used for planning the objectives and then also the performance measures. Okay. So the first topic was what? Mission and mission statement. Now the next topic is objectives. This one is important. Try to remember this. It's like basic only. As we went through what is the purpose for which the company is existing, that is the mission. Mission statements can help to identify an organization's overall purpose. But in order to manage its performance, an organization needs more specific and measurable objectives and targets, right? Like we were saying, the mission is overall what the company is there for. But for achieving those mission, we need to set up specific and measurable goals and objectives. That was what one of the advantages also was, that on the basis of these mission statements, we'll be deriving our objectives. So that is what is given here. Objectives should be quantifiable statements of what an organization wants to achieve. It is important for organizations to set objectives because, first of all, they provide guidance and direction. What is the organization trying to achieve and how is it going to achieve? Second, they facilitate planning to determine how the goals will be achieved. So first one is what is going to be achieved and in a measurable way. Please understand, mission statements are general, whereas objectives are measurable and specific targets. So they provide guidance on what is to be achieved, how it is to be achieved, okay? And they help organizations evaluate and control performance. Management can assess how an organization is actually performing compared to its objectives and can then make any necessary adjustments. So you can first plan And as I said yesterday, planning and controlling go hand in hand. If you have prepared your objectives properly, you can actually check the progress against those objectives and then perform control activity. So that is what is given in point C. First of all, it provides a direction, what the organization is trying to achieve. Then it says how it is going to achieve. And then if there is any major variation, any deviation from the target it was set out for, you can perform control activity. Okay. Hierarchy of objectives. Any doubts so far? It's very basic theory which we are studying. If you haven't doubts, let me know. No doubts. Okay. Hierarchy of objectives. The system of objectives ranges from high-level general objectives to lower-level goals for particular individuals in a clear structure. Now I'll tell you from, so if those of you who are working will already know this. Like when you are working, your manager assigns specific goals to you, right? That this is what you have to do. And everything is very clearly defined at an individual level. So we call them goals because they're specific to you. And these goals are derived from the objectives, which the company is there for. So that is what is given here. The hierarchy of objectives is, it ranges from high-level general objectives and it ranges to lower-level goals of particular individuals in a clear structure. But there's a proper hierarchy, right? You report to someone, then, the hierarchy goes up. So that is how there is a hierarchy for objectives also. Okay. See how it is done. Mission, it's there on the top. With the first topic which we studied, the mission. Why is the company there in a general way? Then, what are the corporate objectives at a corporate level? Then for that each business within that corporate, what are the business objectives? Then comes the within that business at each operational level, like for accounts department, for this marketing department, manufacturing department. So operational objectives. Now within that department, what is the objective of each individual? Okay, I hope you're understanding this. The hierarchy of objectives. It starts from the mission. Then comes the corporate objective. ITC's corporate objective. It was there, right? Strategies, objectives. But let's stick to the syllabus. It's corporate objectives which you're talking about. Then within each of the businesses, FMCG, tobacco and hotel, business objectives, further layering down. Then within each business, ITC's, FMCG's, accounting department, manufacturing department, planning production department. So that is operational objective. And then within each department, let's say for accounting department, Mr. A will have this objective. Mr. B will have this objective. Objectives or goals, you can call it at individual level. Okay. So this is the hierarchy of objectives in the company. Okay. So that was about mission and objectives. Then, as I said, I think yesterday only I mentioned about this, critical success factors. So what are critical success factors? You know it now. The reasons, the factors without which a company cannot exist or cannot succeed in an industry. So critical success factors are those aspects of product or service which are particularly valued by customers and therefore at which a business must excel in order to outperform its competitors. So if you are finding out the critical success factor for a company, so let's talk about Ola, right? Ola's critical success factor. What would be the critical success factor for Ola? What are the things which a customer values? We talked about e-com company yesterday. What could be? Booking, driver cancellation. Yes, very good. Good drivers. What if the driver is fighting with you on the journey? Right? Safety. Yes, Abid. Then Aishi says timely availability. I think this is a struggle in Bangalore. I live in Bangalore, okay? So it's a major struggle in Bangalore at least that when you start booking for a cab, what do? You book Ola, Uber, Meru, whatever, all the 4 or 5 options which you have, you start booking them together. And then whichever driver accepts your request, you go with them. So can we say that the companies, both Ola and Uber, are equally guilty? That both of them, they do not care about this critical success factor. That none of their drivers, they actually come to pick up their customers. They are taking their customers for granted. Because we don't have an option. So you just start booking all of on all of these apps and spend at least good 20-30 minutes to get one cab. And it's very harassing. Right? So each company, they should know what is their critical success factor, because so what has happened recently, in Bangalore, they have launched a new app for autos, and the local auto drivers, they have launched this app, Namma Auto. Okay. So what has happened now, the customers, they're not even taking Ola, Uber, they are going and taking up this local apps autos. So this is what will happen. The customers, they will eventually, they will go away from you. They will not bear your tantrums. One good provider comes and then they will shift to them. And yes, one more critical success factor will be your pricing. So you should be pricing your fares properly. It's exponentially high at some points, more so during the office hours. And so they are definitely, like Ola and Uber are typical examples who don't care about their customers at any bits, like not even the availability of cabs, the drivers' mannerisms. Even I also recently faced one problem. When I booked an outstation cab, the driver didn't come up. He was asking for multitudes of the fare that the app was showing. And when I complained, he just said, ma'am, we will take your complaint into consideration and we'll take necessary action. What is this, man? You're not even bothered about what your customer is saying. So this is something which shows that the company who do not focus on the customers in a proper way, they will definitely lose their customers the moment a new competitor comes into the industry. Yes, it is very highly priced. Absolutely correct. So Uber, Ola, then these are the critical success factors we wish these companies would have lived by and made our lives simpler. Okay. Anyway, so now we have discussed a lot about the different critical success factors. I'm sure you all are conceptually clear what they be. Now let's see. Sources of critical success factor. CSFs can be identified by considering a company's mission or strategy. Now, which tells me, I'll try to look up, give me one moment. Do we have Uber's vision statement on their website? Let's see. We have. Let's see what they have given. Read our full mission statement. We are Uber, the go-getters. Movement is what we power. It's our lifeblood. It runs through our veins. So we see such a general statement they're writing. Okay, from takeout meals to daily essentials to prescription drugs to just anything you need at any time and earning your way, from drivers with background checks to real-time verification. Safety is a top priority every single day. At Uber, the pursuit of reimagination is never finished, never stops, and is always just beginning. Okay. So yes, the company has made very large claims on their mission statement, but we all know the reality, at least in India. I don't know about abroad, but in India, we are really struggling with their services. So CSFs can be identified by considering a company's mission statement. So if they were to live by the company's mission, then definitely they would have also followed their CSF. The external environment. Example from pest analysis or analysis of Porter's 5 forces. Okay, so Porter's 5 forces model is there in SBL also. You'll come across this Porter's 5 forces. And pest analysis is political, environmental, social, and technological environment of the company. And by looking at your environment, you can find out what your critical success factor would be. See, like we are sitting here, we are not working in Ola or Uber, but still can find out what its critical success factor would be. How are we doing it? By evaluating the external environment. Okay. How else we could have found out the CSF of a company? By looking at the mission statement. But yes, if the mission statement is vague or general, then it becomes a very difficult task. But yes, it is a possibility that from there you can find out the CSF, and that's what's given here. CSFs don't only relate to internal processes or aspects of performance. For example, for a road transport company, the availability and price of fuel is likely to be vital for operational planning and could have a significant impact on financial performance. So what they are saying is your critical success factors are not something just internal. So if we are talking about Ola, Uber now, so they have a critical success factor. Let's say they are a very good company. So they have a critical success factor that we want to price our cab fares at least 20% cheaper than the local rates. Okay. Don't you think this will be sufficiently driven by the fuel prices? If the government increases the fuel prices enormously, then providing economic fare to the customers will be a difficult task for them. And then it will say that it's not in our hands. It's driven by the fuel prices, which the governments are changing. So CSFs, they do not only relate to internal processes, but they are also affected by the external environment. That what are the changes which are happening externally, which leads to a change in the way we are functioning. Okay. Then types of CSF. So there are two distinct types. Remember this, okay? Two different types of CSF. First one is monitoring CSF and second one is building CSF. So monitoring CSF, they have a very short-term focus, whereas the building CSF have a longer-term focus. Then let's see what each one of them mean. So monitoring CSF, they have a relatively short-term focus and generally more operational in nature and involving the scrutiny of existing situations. Operational CSF basically, okay? Like example, inventory availability. So for example, in case of Uber, what will be operational CSF? Imagine, I mean, tell me, what will it be? Operational CSF for Uber. Give me examples. For a manufacturing company, they have given inventory availability. Very simple now. Drivers availability. Whether there are drivers, then fuel prices. This is internal, operational factors, right? So this is known as monitoring CSF. Defect-free production, cancellation-free rides. So I hope you can relate. These are all operational in nature and very short-term focused. Is it clear? I didn't get any answers. I hope everything is fine. You are able to follow me, right? Monitoring are short-term and operational in nature, right? Like driver availability we discussed, then cancellation-free rides, car hygiene. These are all simple operational factors. Then building CSFs. So these have longer term focus and are typically future oriented. These were short term and are operational in nature, monitoring. Building are long term and future oriented. They will be important for helping an organization build strategic capabilities so that it can adapt to changes in its external environment. Example, innovation. Now, Ola getting into electric vehicle segment. Is it an example of monitoring CSF or a building CSF? Critical success factor for the long term, right? So you can think about it. So a lot of such examples can come to your mind. So since we're talking about Ola, Uber, we can think about Ola's introduction of electric vehicle segment, introducing additional services like delivery service. Absolutely, very good example, Ayushi. So now they have started delivery of, Uber Connect is there. What do? Parcel, pick up and drop. Earlier, there used to be smaller apps for these things, but now they have included Uber Connect as a part of their main app. Okay, then Ola Outstation, Uber Rentals. What are they? They are providing rental of cabs also. Like, it's not just one point pick up and drop. They just started off like that, right? Pick up and drop. But now they are into rentals also, like hourly rentals, daily rentals you can do, outstation rides you can take. Yes, Sheldia, Zomato's fast delivery and intercity legends. So Blinkit is of Zomato only, right? So what is it doing? Delivery within 7-8 minutes. These are the building CSFs. Thinking long term and future. How are we going to sustain ourselves in the long term? Only if you have critical success factors defined like these, then only you will innovate. Okay, so launching new products or services, developing new competencies. So innovation is there in a lot of tech companies. Then also like TCS, Infosys, they are developing new competencies. Who knew we could be conducted classes like this? These are all new competencies, and definitely Zoom as a company would have thought at one point of time we will be delivering something like this. Okay. So these are the types of CSF. Remember them. Monitoring and building. Monitoring is operational in nature. Building is future oriented and having a longer term focus, like innovation, launching of new products. Okay. So we will stop here. The next topic is key performance indicators, which I was talking about, that both of them, CSF and key performance indicators, go hand in hand. So today what we have done, we have identified that these are the factors important for the long-term growth of the company. But yes, these are factors. How do we measure them? That is measured through key performance indicators. Okay. So we'll take this up in the next class. It's a long topic. We'll take some time. So since we're already just near the closure of the classes time, we will take it up in the next week. She says, ma'am, do we have homework for this week? No homework for this week. Enjoy your time. Let me complete 2-3 chapters and then I'll start giving you homework. Okay. Yes, so let's meet next week. I'll share across chapter introduction notes and chapter 1 notes, chapter 2, which I have just started. Let me complete this and then I will share across the notes with you. We'll get it in a drive. Sandeep will be sharing the link of the drive in the group, so you can download the notes from there. Okay. Thank you so much, everyone, for attending the class patiently. Have a good week ahead. Take care. Bye-bye.